One moment. For some reason, I thought it was, but it is not showing. So I may have to, just to be respectful of everyone's time, um, share it next time. But I have been in the insurance industry for over, like I said, 15 years. And I've held different positions within the insurance industry, such as senior manager, director of operations. I primarily had the majority of my career on the P&C side, which is property and casualty, so homeowners, auto insurance. I did not sell it. I was the person on the back end that when you have to file a claim, if you're like, I got this coverage and I'm supposed to be covered, right? I was the person that if you were denied coverage, or you didn't understand your coverages and that adjuster told you one thing and you asked to speak to a manager, you would then speak to the manager. And if you didn't like what the manager said and you wanted to speak to someone higher up, I was that higher up person that would make that final decision on whether or not coverage would be afforded or whether coverage would be denied. Why do I share that? Because I come with a different skill set of your normal, your typical adjuster, your typical agent, I should say, because I have policy interpretation and coverage analysis in my belt, which is critical when you're getting a policy or when you're really thinking about becoming your own bank and infinite banking. Everyone just thinks you get it and it's all the same, right? And I've talked to people who said, I got this policy or I got that, but they're not all created the same. Okay. So that is my different skill set or unique skill set that I come with. And I just look forward to really exposing you guys to the different things that you can truly do when it comes to really putting things in position to becoming your own bank and infinite banking and what that really means and not what social media is showing you. You put money in kind of like a microwave. It really is a slow cooker. So the clients that I work with, I teach you how to cook the food, if that makes sense, right? Um, so I'm going to share my screen. Let me know if you could see it. And as it's coming up, I also want to just share with you all the reason why I left corporate America and decided to start my own agency. It's called Solomon Financial Solutions. And the reason why it's called Solomon is because Solomon was the wisest man in the Bible. And so I told God that when I was going to step out and leave corporate, and yes, I'm leaving a six-figure job, I'm leaving leadership, all of that, that if I was going to step out and be obedient, leave corporate, that I wasn't looking for anything else. I was just looking for knowledge so I could be able to pour into everyone else. So I just want to be a pitcher and you all have your glasses out so I can pour into you while he pours into me. So that's the backstory of why it's called Solomon Financial Solutions, because he's rooted in everything that I do. I am a believer. Um, and so I just wanted to just share that with all of you and the reason why. The other thing I want to share with you as well is the reason why I left corporate and came to this side is because, again, I shared with you, we were on the back end where we make that final decision. Yes, coverage is afforded. No, coverage is denied. The client may think, I do have this coverage. My agent told me I have it, and they really didn't. Or the agent didn't really understand the policy when they were selling the client the policy, whether it's for homeowners or auto. And so what happened is I had to kind of step out and go to different summits and speak on different panels to different agents or conferences to really push to them that the importance of you need to understand what it is that you're selling, not just what's on the front end, but what's the nuts and bolts. Okay. So the way you can think of it is we're at a restaurant. I'm the chef in the kitchen. I didn't create the recipes, but I know the recipes. What are the recipes? The policies, right? Now, the hostesses and the waiters or waitresses, they are the agents. You ever been to a restaurant and you ask someone, hey, what comes on this? And they're like, I'm not sure. They got to lean over and look at the menu with you, and then they got to read it off. Or they say what? Oh, I'm not sure, but I'll ask the chef, right? So you can kind of think of it like me being the chef in the kitchen and a lot of orders coming to the back of the house that are incorrect, that are wrong, um, and they're not anticipating your needs. And what do I mean by that? Is that you order something, you might say, okay, I got a shellfish allergy. and I ordered the chicken. So I should be okay. I should be straight, right? Because I ordered the chicken. But that host or that waiter or waitress didn't anticipate your needs by asking you, hey, just so you know, this chicken is cooked on the same grill as the seafood. Do you have a shellfish allergy? That's anticipating your needs. Now you're like, I didn't even think of that. Yes, I do. Now they're able to say, well, you might want to get this instead because of that. Okay. So as the chef, so many orders were coming back to the back of the house wrong, and I decided to come to the front of the house. Okay. So I'm going to share my screen with you all, and I want to just talk about what it truly means when we talk about infinite banking. Like I said, everyone hears it, everyone sees it, everyone gets hyped up, and they think it's one thing versus another thing. And they're just really just confused. They don't really know what it really means, right? And so, what social media makes you all think is that it is a microwave. You see the people nowadays, they're like, oh, put the money in here and you flip it and you take it out and you ain't got to pay it back and you don't got to do this and do that. But no one's really educating anyone on what that really means. So, how I like to look at it and tell everyone, or sometimes you'll see people and say, they'll say things like, take all your money out and put it in here instead of putting it somewhere else. Well, the way that I like to think of it is having a balanced life. Okay. And what do I mean by that? Well, essentially, all of us in our lifetime, we're going to make a lot of money. You guys are going to see me looking on different screens. So I am here. I just have multiple screens. Okay. So I might be looking away left and right. So essentially, in our life, right, we are going to make a lot of money. Okay. That's the reality. And a lot of us have sat before and we've said things like, if only I was a millionaire, if I had $1 million, I would do this. But many of us don't realize that we've been millionaires already, or we've been millionaires time and time over and over again. Why? Because we're going to make a lot of money in our lifetime, but we don't see the money. Why? Because money is always moving. Okay. It's always moving. We get the money comes in. That's why this bucket is so big. That says lifetime capital potential. Okay. The potential of how much you're going to make in your lifetime is going to be a massive amount if you ever tracked it, but you don't see it because it's always moving. Why? Because we all have stuff we got to pay for. We got to live. We got to eat. We got to buy clothes. We got to even have things that bring us joy, vacations, trips, subscriptions. I like Netflix. I spent the whole weekend watching How to Get Away with Murder. I need my Netflix. Okay. So, and listen, don't be alarmed by the name of the show, okay? It's on ABC. It got Viola Davis in it. It's called How to Get Away with Murder, so don't be shocked by that. But I spent the whole weekend watching all the seasons, and I need my Netflix. But money is coming in and money is going out, and I don't really see all the money that I'm going to amass over time. And so many of us, what happens is the money comes in, you budget, you do everything you need to do, but before you can even pay and spend anything, it has to do what? It has to make a pit stop. The pit stop is who? Your business partner. Okay. Does anyone know who their business partner is? And also, if you're new here, I like participation. It makes me feel like I'm not here alone. In the digital space, you don't hear nobody, and sometimes you don't see nobody. So if anyone can think about it, like, can you just drop in the chat, like, who our business partner is? Because we have a business partner, whether we like it or not. Whether you're an entrepreneur, whether you work a 9 to 5, it really doesn't matter. We have a business partner and we can't escape that partner, period. Okay. So let's see. Sammy, yes. Sammy, IRS, taxes. Exactly. So we know when we get that money has to go down that tax filter because our business partner takes their cut. First of all, they didn't even go to work. They didn't put in the hours. They didn't do anything. Okay. They didn't make the drive, but they take our money first. Okay. After your business partner then takes the money who didn't put anything in. Okay. And I thought about Friday. I don't know if you haven't seen Friday. Okay. When Smokey was like, you ain't put in on this. Okay. So that's what I'm thinking of. They didn't put anything in, but they take their money. And then whatever's left, that's then what we try to live our lives on. Okay. And that's when it goes through the after tax cash flow pipeline. What is that after tax cash flow? It covers your rent, your mortgage, your clothes, your entertainment, vacations, food, the kids' AAU sports, extracurricular activities, all of that. And if you notice, as it goes through the after-tax cash flow, it funds your current lifestyle. And current lifestyle, remember, it could be anything. It's the subscriptions, it's all of that, right? But what happens is when it goes through that, it's gone. Okay. Same way like how it goes through that tax filter, whatever you just made, whatever goes through the tax filter is gone. Okay. Whatever else now is funding your current lifestyle, it is gone. You don't see it anymore. But a lot of us, what we do is we make the mistake where we forget about our future selves. Okay. So the future Christina is the current Christina is living life like normal, and she's forgetting about the future Christina. Okay. And essentially, what we should be doing or how we should be living our lives is we should be having the money coming in. And this is typically how money is just flowing, how the cash flow goes. Okay. This is just showing you how cash just moves, how money moves. Okay. This is what the representation is. You have the money come in, it goes out tax filter, the rest, it funds your lifestyle. Some of us, not all of us, okay? Some of us think about our future self, and some of that money goes up the future lifestyle pipeline, and some goes into the investments tank, some goes into the savings tank. For anyone who's working a W-2, you have the money come in before it goes down in that lifetime capital potential bucket to go through the tax filter. It goes, some of you goes through that qualified plan contributions, which is what? Your 401k, TSP, 403b, SEPs, all of those are those qualified plans where we take some of our money, we drop it in that bucket, and then the rest just flows through. And then what happens is we think that, okay, when we put the money in, how money should flow is money should be going in those buckets, investments and savings. I like to call them the risk bucket and the safe bucket. And essentially what should be happening for our future self, so like that future Christina, she should be able in the future to turn on those two valves to start emptying out the risk tank and the safe tank so she can fund her future lifestyle, which at that time will be her current lifestyle, as if nothing changed. So she could be able to fund her future self like she's funding it today or better. Okay. Now, I don't know about y'all. Y'all might be comfortable with how you are today and be like, yeah, girl, if I live my life the way I'm living it today, in the future, I'll be fine. That's not how I think. I want to live better in my future than I'm living today, even though I'm comfortable with today. Why? Because inflation. Inflation, things change. What costs today, y'all see eggs. I went to Waffle House the other day and they upped the charge. And on the menu, it literally said we had to up the price because of the cost of eggs. Okay. So when you think about that, you want to always think about living better. But what's happening is you have some people who are living their lifestyle. They're living it in a way where they are either pumping all their money to their current lifestyle and they're not saving for their future. Or you have some people who are pumping all their money in their future lifestyle and they're nickel and diming themselves currently. Okay. But what we essentially want to do is we don't ultimately want that. We want to be able to be balanced because why? That makes us unbalanced. Because if you're doing too much, too little today and doing too much for your future, you're unbalanced. If you're doing nothing for everything for today and nothing for your future, you're unbalanced. So when we think of infinite banking, the goal is to make sure that you are establishing yourself not just for where you're able to live life today, but you're establishing yourself for the future while at the same time you are protecting your family, that just in case you are no longer here anymore, they are protected. Does that make sense? Drop a one in the chat if it makes sense so far. I like to go, when I'm talking, I like to talk a little slow and I like to talk in layman terms because a lot of people, when they're presenting, they speak in jargon and do all this extra stuff, okay? So I say all that to say why, because what happens is people put all their money, when you go back to, when you think of that future self, you think that, okay, I'm putting money in my 401k, and people who have met with me, my clients or people who have met with me, they know the story where I have said when I was younger, I was 20. I started working at 16 at Universal Studios. But when I was 20, I started saying things like, oh, I don't even save my money. I'm gonna get Social Security. Like I believe that 1000% because my financial literacy was they're taking money out of my paycheck. They're putting it away for me. And I'm gonna have all this money when I retire. So I could spend all my money that I'm getting because they already took a piece to put it away from me. Okay. So I'm thinking everything's okay. So because of that, I'm not saving anything. But then there's others who think that I got a 401k at my job. I got 200,000 in there and they thinking they doing the thing. Okay. And it could be you. You could be on the call and you might be thinking, I don't even got 200 in there, Gerda. I got like 2,000, and that's okay. Give yourself grace wherever you land, okay? But what happens is we all think that because we have just a little bit of something in here and a little bit of something in here, that we're set for the future. But what we don't realize is, remember that business partner I told you down here? Well, that business partner is also somewhere else, okay? So I'm just going to take a moment and then we're going to get back to what I was saying about how we want to make sure we want to establish ourselves for our future self. But when we talk about that business partner, if we go back over here and we talk about qualified plans, okay? Qualified plans, does anyone know when qualified plans were introduced? Like in what year or what decade, I should say? Because it hasn't been around that long. It hasn't. I mean, if you don't know, it's okay. If you want to give an educated guess, cool. But if you don't know, thank you, Divine. I don't know. Yes, and Kairos said the 80s, and Kairos is right. Okay, it was the 80s. Okay, and it was created with the intention to try to sway people from putting their funds in something else that not only is their money protected, okay, it grows tax deferred, okay, tax free, okay, it's unstructured, guaranteed loan payments. They were trying to get people to move from that area to something else. So what did they say? They said, okay, do this 401k, your company will match it. And you're going to have this money in retirement and all of this stuff, right? And then when you donate that, when you contribute that money, you're going to be taxed less because your taxable income is going to be lower. So everybody thinking that it's a win-win. I'm putting money away and I'm going to be taxed less. Okay. Well, what people don't even realize is when the government makes you put money in those qualified plans or your employer, you make that decision, all you're doing is kicking the tax can down the road. You're just delaying the tax. Not only are you postponing the tax because they're going to tax you, but that's the other place that your business partner is sitting. They're sitting in here. They're going to tax you, one, and then they're going to postpone the tax calculation, okay? Which means if they decide they're going to take 50%, they could take 50%. If they want to take 70, they could take 70. If they want to take 80, they can take 80. And some of you might be thinking, Gertie, you on a little extreme. I don't know if they'll take 80. Well, some of you don't even know at some point in time, the government took as high as 95%. Okay. And that's why you have to always look back and see what did the past do, because the past will teach us about the future, because one thing we know is history does repeat itself. Okay. And when they did that, it was around a lot of times when it was around the times of war, right? Income tax was created in 1913. If you really want to get nitty gritty, it was created in 1913 and it was created after the Civil War to be able to get us back, the economy back on track. It was supposed to be temporary. It's not been temporary. Okay. And they have increased taxes as high as 90%. And at one point, taxes were 80% on anyone who made $5 million or more. And I believe this was back in maybe in the 1930s, 1940s, don't quote me. But it was about anyone who made $5 million or more, they taxed you at 80%. The very next year, they not only increased the taxes to 88%, but they dropped it from 5 million to anyone making over $200,000. So they dropped it to 200,000, but they raised the taxes. So just keep that in mind as you go along and as you're determining where you're going to put your money, because essentially if you dump it in this risk tank, okay, the government decides how much they want to take. So you might have all that money sitting in that 401k and you like, I need to dump as much as I can in there. Like I used to do. I used to go up to 12% when I worked in corporate before I stopped contributing to my 401k when I became knowledgeable. Now I'm not telling you to stop, but what I am saying is I used to go up to 12% and my company only matched 6%. And I did that because I thought I was doing big things. And I was like, I want to put as much money as I can. But I didn't realize that I was putting all my eggs in one basket, that if the government decides, well, if taxes go down, they'll take less. But what do we know? Taxes ain't going down. And look, I'm not here to advocate for no candidate or nothing, okay? But what I'm saying is, listen, whether you like Trump or don't like Trump, Okay. I ain't gonna lie. When he said he was gonna get rid of income tax, I was like, how soon can you do that? On the day you get into office? Okay. Income tax it's still here. Okay. But if it still stays here, whether he gets rid of it or not, if he gets rid of it, the same way they were able to introduce it is the same way they could bring it back. Okay. So you always need to keep that in mind. If he gets rid of it, he only got 4 years in office. Once he's done, if someone else comes in and they want to introduce it, if he gets rid of it, great. Someone else can bring it back and they could do whatever it is that they want and they could determine the tax calculation. So essentially, I like to also call this the evaporation tank, which means your money that's sitting in here, you can wake up one morning and it's gone. And you could also be sitting in here and thinking, oh my God, I got a Roth IRA. I'm putting money in there, I'm gonna get it tax free. Well, when you put that money in there in the Roth IRA, guess what? It's also in the what? It's in the risk tank, which means you could wake up one day and it's gone. Why? Because it is exposed to market volatility. It is not safe. And that's why this tank right here does not have a cap on it. There's no lid on this investments tank. But if you look over here, the savings tank has a lid on it, but there's nothing on the investments. Why? Because it could evaporate. Okay. You could wake up one morning and it's gone. If you don't believe me, look at the Great Depression. Okay. Look at times of war. Okay. Even the housing market crash, what, in 2008? Look at that if you don't believe me. So essentially, what we want to get you all to do when you start thinking of infinite banking is where can I put my money that is going to be safe? Okay. But not just safe, but also offer me other benefits. If I'm truly thinking of how I can utilize or how I can create, basically, I like to call it a family bank. Okay. And think of that infinite banking. What is it or what vehicle can I then use? So some of you might be saying, okay, well, I got money in the safe tank. So that's good for me, right? Well, that's great and fine and dandy, but there are certain types of vehicles within the safe tank that you put that money in, and guess who's also in there? Your business partner. You don't believe me? Earn interest, whether it's 10 cents or $20, whatever the case may be from your bank. What do you get at the end of the year or the beginning of the following year to file your taxes? They want to account for everything. Okay. So you got business partner in here, business partner is all up in here, and the business partner makes you make a pit stop over here. Okay. At the tax filter. But what we're saying is, yes, there's other vehicles you could put the money in, and you could be thinking, I could have money in my savings account or another financial vehicle, right? Where I put my money in and I do my infinite banking. Okay. And that's what I'm using. But what's happening is when you use something else, a different vehicle, let's say a savings account as your infinite banking strategy or financial vehicle, you don't even think of the opportunity cost that you're giving up. Okay. What do I mean by that? Well, even though it's in the safe tank, put a one in the chat if you're still following me. Okay, good. And what you'll learn about me, I'm a little different. I like to educate. So I could have just jumped in and said, yeah, let me show you how to do infinite banking and use these policies and get this money. But you have to really understand certain things beforehand so you can really understand the importance of what you're saying when you say, I want to become my own bank. I want to really put infinite banking into strategy and to play for my family. You have to really understand the dynamics as to why other things may not work, or as to why this may have different nuances in it so you could better understand, because I like to educate people so your wheels can spin. All I can do is give you the information, but I can't tell Eric exactly what to do. I can't tell Jessica exactly what to do. I could just give you the information, and those wheels can spin in your head on how you want to use what you have in your hand to accomplish your ultimate financial goal. Okay. So if we think of the savings account, all right. All right, perfect. If we think of a savings account, we talk about opportunity costs. And now we're thinking of infinite banking. A person says, I use my savings account for infinite banking. Okay, that's fine and dandy. And just to make numbers easy, I'm just going to use an easy number. Let's say this person has $100,000 in their savings account. Okay. And yes, if you're here, I did look into a stylist. Anyone who has been here before, you already know I am using the mouse to write. So it looks like I got ugly handwriting, but I promise you I got very beautiful handwriting. I can vouch for that. but I'm using my mouse to write. And I know last time I was like, y'all, I'm gonna get a stylist. I have tried. It's too tech savvy for me, and y'all know I'm not tech savvy. It's something about I got to get an iPad, to get a stylist because I got a MacBook. It ain't working. Okay, so we're gonna get this ugly handwriting today. Okay, but I hope it makes sense while I use it. Allegedly. No, Eric, I got good handwriting. Okay, I promise. So let's just say the person has a savings account. They're trying to use and do infinite banking. Okay. And they come to you and they say, Cairo, I don't need nothing else you're talking about. I already do infinite banking. I use my savings account to do that. Okay. Well, this person has 100,000 in their bank account. Let's just say they take out $40,000, okay, to go and put down on a property. I don't know. We might have some real estate people here. We might have other people who are thinking about it, whatever the case may be. But that person takes out 40,000 to go put down on a property. Okay. Well, when that person takes out the 40,000, how much do they have remaining in the bank? They have $60,000. What did they give up? They gave up earning interest on that 40,000 when they took it out, because now all they're doing is earning interest on $60,000. Okay. The minute they withdrew it, they're just earning interest on 60,000. Okay. And that person could come back and say, well, Cairo, yeah, I'm only earning interest on 60,000, but I'm gonna pay myself back. And I'm gonna put the money in, and every time I get paid, I'm gonna deposit 1,500 and I'm gonna get myself back to the 100K. Well, what that person doesn't realize, with every day that goes by, not just, oh, they might say every time I get paid. Well, you might get paid weekly or biweekly. But what you don't realize is every day that goes by, every moment that passes, that person is giving up the opportunity to have earned interest on that money that would have been there if they didn't take out the 40K. Regardless if they get back to the 100K, let's say it took them 3 months to get back to the 30K. Well, they gave up 3 months of earning interest. It's gone. They will never get the opportunity back to earn interest on that 40K that they took out initially. Everybody follow me so far? So that was the opportunity cost. Y'all got me? Okay. Now, when we think and we start expanding our mindset and we think of infinite banking, I like to think of it like my mentor, he said something really great where he compared it to a parachute. So you got to think of your mind like a parachute. What happens if you jump out of a plane and you don't open up that parachute? You already know what happens. The only way to survive is to open up the parachute. So think of that like with your mindset. When you start saying, so the fact that you're on this call today and you're like, okay, I want to know more about how I can apply this infinite banking, you've already opened up the parachute. The fact that you're already in Christina's workshop for the trust, you've opened up the parachute. So now when we think of the other side and we start thinking of, okay, infinite banking, now let's talk about Cairo then goes to his person and he says, okay, well, that's fine and dandy, Bob. And he says, okay, well, Bob, I have 100K, but I have 100K sitting in a different type of vehicle. Okay. This vehicle, oh Lord, that's a big K. Okay. This vehicle that I have my money sitting in, I see the same thing that you're trying to invest in. And you know what? I'm gonna do that too. Let's say it's a community, they're doing quadplexes. And if you've talked to me before, you know I love quadplexes because that's the strategy for my daughter who is 17. I don't know much about real estate, but one thing I know is I can get a quadplex, okay, with the same kind of loan I can give a single family home. That's all I know, okay? But let's just say Kyra says, okay, I want to go get this property also, and he wants to go get a quadplex. So he takes out 40K. Now, Kyra has his money sitting in something different, okay? We're not going to talk about that yet, what it is that he has it in, but Cairo has it in something that's different. Okay. So Cairo takes out the 40K. Now I'm just going to draw something that kind of looks like a cup. Okay. So now let's just say that Cairo, and let me see if I can get rid of some of this stuff. Give me 1 second. I don't know if it's going to let me. Okay. Give me 1 second. Okay. We're just going to leave it there. So I don't want to mess nothing up. So Cairo, he has the, go back. Okay. See, that's why I don't like messing with stuff, y'all, because I am not tech savvy. Okay, give me 1 second. Make it easier. All right. So Cairo has the money in something else. He has 100K. He takes out 40K. Okay. He goes and he buys this quadplex. So Cairo, if we think about it like Cairo having a cup, Cairo took out 40K. So Cairo's cup has what left? 60K left in it. Okay. His cup has 60K left in it. But because Cairo has his money sitting in something else, Cairo is still earning interest on 100K, even though he took 40K out. Okay? You following me so far? Drop a one, do a nod if you're on camera. I just want to make sure before I keep going. Thank you, Ronald. So Cairo's still earning interest on 100K. He took out 40K. His cup has 60K. So let's just assume that the 100K that Cairo is still earning interest on, we're just going to call that our statement balance to just make it easy. So we're going to call the 100K that Cairo has sitting in this account his statement balance. He takes out the 40, he buys the quadplex, he has 60 left in his cup. So cup is a different amount, statement balance is a different amount. Follow me? He's earning interest still on the statement amount, even though his cup has 60 in it, okay? Which means if Cairo was earning 5%, let's say Cairo owned 5%, he earned 5%, okay? A year later, if Cairo was earning 5% interest, a year later, what would Cairo's balance be? What would his statement balance be? If he earned 5%, what's his statement balance a year later? And you could drop it in the chat. You could come off mute real quick, say yes. Exactly, Chris. A year later, his statement, yes. A year later, his statement balance is 105,000. Why? Because he earned 5% on his 100K. Okay. So he earned $5,000 on his 100K, even though he took out 40 last year to go buy this quadplex. So now Cairo made money off the same dollar twice. How? Because when he went to go buy the quadplex, what happens with real estate? If you buy it in a good place and a good time, okay? It appreciates. And let's say it's appreciating in value. He's actually making a little bit more money instead of money twice. He's probably making it 2-3 times over. Why? Because he bought the quadplex. He got tenants in all of them, or maybe he's living in one and he's renting out the other 3. He has the cash flow coming in. Whatever the difference is, he takes out the money. He pays the mortgage each month. He has now this extra cash flow after he paid all the mortgage and whatever it is he needs to pay with that. He has a little bit left over. Okay. So that's him making some money there. The quadplex is appreciating, it's gaining equity. Okay. He making money there. He just made $5,000 off the 100K. That's his statement balance. He made money there. Okay. And even though his cup has 60K in there, he made money three different times off the same dollar. Okay. Now, if Cairo decided, you know what? And let me back up before I even go to that part. So when Cairo, a year later, he made his 5K, now his cup went to what? That's ugly, y'all. I'm just going to write it on the top. Okay. His cup went to what? His cup went to 65K. Why? Because remember, he took out 40K from the 100. He had 60K left. Okay. He earned 5% off the 100K, which was his statement balance. Okay. So they dumped that $5,000 into his cup. Now Cairo's cup has what? $65,000. Y'all following me so far? Give me a 1, give me a sign. Got it. Okay. So now Cairo's statement balance is no longer 100. Cairo's statement balance is what? 105. Okay. Why? Because he earned 5% from last year. So his statement balance is now 105, which means if Cairo earns 10%, right, next year, he's going to earn 10% off of 105. So now we're talking about compounding interest when we are still in the realm of infinite banking. Everybody with me? But Cairo's cup was we just dropped the 5,000 in there that he earned from the prior year. Okay, cool. Now, when we talk about infinite banking, what I always like to tell all my clients is pay yourself back. Why do I want to say that? Because too many people on social media, everywhere, left and right, they try to make people think, and it's unfortunate and it's very frustrating because they try to make people think it's a microwave and they don't want to tell people it's a slow cooker because, whatever the person's intentions are, I don't know. But it is one of the most powerful things that you can have that is out there. Okay. And it's never, only people who really knew about it or would utilize it to its maximization or its full capacity was the wealthy. Okay. Those who did know about it, who were may not have been wealthy, didn't want to share with nobody because they just kind of want to keep that information to themselves. Okay. And it could very well be why so many people on social media are pumping it out like it's a microwave and making you think, put your money in here, do this, do that, like it's so quick, right? Is because they don't even either want to give you more information and answer and be truthful because they probably don't know. Or to be honest, they really just trying to get people, like they trying to get leads. They trying to get you to make an appointment. Okay. But I'm here to tell you that it is a slow cooker. But one thing we know about slow cookers is when it starts cooking, it starts cooking. Okay. So when you think of infinite banking, you're getting that money that's still coming in because you're earning it off of what? Does everybody remember what you're earning your interest off of? Is it the cup or is it the statement amount? Just drop it in the chat. Is it the cup or is the statement? Yes, Chris, it's the statement amount. Okay. And so what I always advocate my clients is I tell them pay yourself back. Why? Because like I said, social media will tell you, you ain't even got to pay it back. You can take the money out and you ain't never got to pay it back. Listen, is that a fact? It is a fact. You don't have to pay it back. Okay. However, why do I tell people pay yourself back when you're thinking of infinite banking? Again, I haven't told you what vehicle he even has the money in, Kyra even have the money in. I'm just telling you, if you are thinking of infinite banking, keyword banking, when you say become your own bank, keyword bank, your own bank. What do we all do when we go to the bank? We respect the bank. How do we respect the bank? We go get a loan, and if I ask to borrow some money from Anthony is gonna say, yeah, Gerda, I ain't got it because I gotta pay my car note. Or I ain't got it, I gotta pay my credit card. Or I gotta pay my mortgage. Why? Because he gotta pay the bank back. So when we think of becoming your own bank, we need to start respecting our family bank, your own bank, becoming your own bank, infinite banking. You now are assuming the responsibilities of what the bank has. Okay. Which means if you're going to borrow from your bank to do infinite banking or becoming your own bank, you need to respect your bank, your family bank, as much as you respect, more than you respect someone else's bank, which is why I say pay yourself back. Social media tell you ain't got to, which is true. However, I say pay yourself back. Why? Because remember how Cairo took out 40K to go buy the quadplex? Yes, he earned 5% interest the next year. And yes, he was earning interest off the 100K. But when he took out that 40K, his cup had what? His cup had 60K left in it. A year later, when he earned the 5% interest, which was the $5,000, they dropped it in his cup. Now his cup has what? 65,000. But what if Cairo paid, let's just say whatever Cairo did, he won the lottery. I don't know. Let's just say Cairo paid himself back that same 40 he took out. Well, what does that do? That fills Cairo's cup back up. And that now gives Cairo complete access to his full 105. Does that make sense so far? Okay. Which means if Cairo didn't pay the 40 back, let's just fast forward a year later. Cairo took out 60 last year. I mean, he took out 40 last year. He has 60 left in his cup. A year later, he earned 5% interest. He's now at 65% in the cup. Cairo sees another opportunity. Boom. He got a whole community that someone says you just got to put 80,000 down. Okay. Can Cairo go get that community? He can't. Why? Because his cup only has 65,000 in it. Why? Because he took out 40 last year and he just earned 5% interest, which was $5,000. So his cup is now 65,000. Cairo can't go get that property and put down that 80,000 for that whole apartment complex. He don't got enough. Even though his statement balance says 105, why 105? Because he earned the 5% interest. His cup only got 65. But if Cairo paid himself back, whatever that was, because the payments are unstructured, which means when Cairo went and took the 40 out of his bank, his family bank, it wasn't like, oh, Cairo, in 30 days, you're going to have to start paying $500 a month, and this is going to go to interest, this is going to go to principal. No, Cairo now was operating like the bank. So Cairo, when he took that 40, he need to figure out what's the plan? What is my plan as Cairo that I plan to pay my bank back and put that money back in? Y'all following me so far? So when he saw that property that was 80 something thousand, he couldn't get it because he never paid himself back. So that's why I always advocate and tell people to pay yourself back. Now, you might be like, okay, well, Gerda, what are we talking about? Because I don't really know what we're referencing here, okay? Let me see how I could turn this off, y'all. Hold on. Turn this off. Okay. What are we referencing here, right? Well, what we're referencing is cash value insurance, okay? But when you think of it, you're like, cash value insurance, right? Yes. When you want to become your own bank or infinite banking, this is where the concept was pioneered through cash value policies, okay? For those of you who don't know or you haven't seen me present in other areas, who's been to Disney World? Put a one in the chat. I mean, I'm from Orlando, the land of Mickey Mouse, okay? So I've been there forever, okay? Don't want to really go no more because I'm Mickey Moused out, okay? But what you don't realize is that Walt Disney World, people don't even know that he went to 301 banks to try to get a loan to start Walt Disney World, and every last one rejected him. 301. Some of us, we went to one bank or two, and they denied us, and you get the letter in the mail, okay? And why do I share this? Because I've been there. Back in the day, oh, let's be real, okay? Just because you see me here today and I'm speaking, don't assume I have not been where you've been or where you currently are, and I don't understand, okay? My parents are immigrants that came to America. Okay, so I didn't have the ability to have all this financial literacy. I had to learn stuff as I went along and read things. Okay, so yeah, you probably went to one or two banks and they probably denied you. Get the letter in the mail and they say, okay, we pulled up your credit and this and this and that, and you didn't get it. Yes, I am Haitian. So, you didn't get that. Yeah, my name gave it away, Gerda Pierre. If you are Haitian, that's the most Haitianest name ever. Okay. But you get the letter in the mail, but Walt Disney went to 301 banks. So if you're talking about tenacity, you're talking about ambition, he went to 301. Okay. I'm not gonna lie, I probably would have been discouraged after 10. Okay. But 301 banks, they all turned him down. But guess what? He then started Walt Disney World by going to what? His family bank. Okay. J.C. Penney during the Great Depression, he would have lost everything. And that's a clear example. He had money in the risk tank. Okay. He lost everything, money that was in the risk tank. But he was able to keep the operations of his business going by tapping into his family bank to keep the operations of his business going. Okay. We could even talk about McDonald's. Okay. So why am I mentioning this? Because these are power players that we all know. And we don't even know that they got their start or continued, they had their business sustain operations by going into their family bank. Okay. So why is it so impactful? Because I'm going to use Cairo again only because I've been using Cairo. I don't even know if Cairo is still on the call or not, but we're going to keep using his name because we use him as the example. Okay. Remember, Bob had the money in a savings account. Bob lost the opportunity to earn the interest. Cairo had his money in something else, but Cairo, even though Cairo was borrowing money, Cairo was paying himself back. And as he's paying himself back, whether he borrowed it and didn't pay it back for a few years or paid it back next year, whatever the case may be, Cairo's cash was growing. Okay. And that's where that eighth wonder of the world comes in, that compounding interest. Okay. It's growing. But if you notice, there's also a blue shaded area. What's that shaded area? That's the death benefit. I want to pause right here. And I want to say the misconception that insurance has had over decades, years, right, is that People run from it because they don't want to talk about it because they think it just talks about death and all of this. But what people don't realize is it's not called death insurance. I think we've gotten into a habit where we're making things more complicated than what it is. Um, it's like if someone tells you what they mean, then they mean what they say. So it's called life insurance. It's not called death insurance. And over the years, we've made it into something it's not. And so what do I mean by that? It's called life insurance, which means you're supposed to use it during your life. It's called a death benefit. It's exactly that. It's a benefit of your death, which means during your life, you're using it because it's life insurance. And when you're no longer here, because death will occur, whether we want to talk about it or don't want to talk about it. When you're no longer here, those you love the most will benefit from it. Y'all got that? It's death benefit, life insurance, life insurance. I actually like to go a little further and call it love insurance. Why is it love insurance? Because you only get it for two reasons. You get it for yourself, which you love. Why do I say yourself? Because there's living benefits that go along with this, which I'm going to talk about. And you get it for those you love. You get it for yourself, who you love, and those you love. It's love insurance. You don't get it unless you love someone or something, right? It's love insurance. So while you're alive, you have other benefits that come with it. But what I want to highlight is, as you see, the money was growing in Cairo's account. He put the 100K in there. He took out the 40, but he was still earning interest. He might have decided he's going to pay back that 40 over a course of 5 years. Why? Because that's just what Cairo decided. He did his breakdown. He decided he's going to pay it back over the course of 5 years. But as his cash value is growing, what is also growing? What do you notice is growing? His death benefit as well. And so when you think of the green area, his cash value, you can think of that as his private reserve, that hidden account inside of the policy. Why do I say hidden? Because it's safe from taxation, it's tax-free, it's tax deferred, it's safe from lawsuits. It is one of the most protected places you can put your money, okay, and allow it to continue to grow, okay? And so while his money is growing, his death benefit is growing also, okay? And so when we start thinking of infinite banking, I don't want you to just be thinking, okay, how can I put money in here and take the money out and then just do what I want with it and never pay myself back? No, if that's the case, you haven't, just like what Divine says, you haven't had a mindset change. That parachute is still closed. And what I like to tell people is I don't take on every client. And I'm going to be very honest with you. Why is that? Because I have 4 policies, okay? I have 1 term, I have 1 whole life, I have 2 IULs. Why is it? Because I realize that these are one of the most powerful things ever that can change the trajectory of my family when I'm no longer here, but also care for me while I'm here. What do I mean by that? That living benefit that I mentioned to you. Also, when you think of infinite banking, you don't want to just think of just the cash that you can build into and what you can do and how you can flip it and how you can take it out and do all of this. But there's other things that it also affords you. Because like I said, 1 thing's for certain, 2 things for sure, we will no longer be here anymore at some point. The other thing that is certain, but it's not necessarily guaranteed for all of us, right, is that we are all going to get to an old age where we can no longer do the things we do today. And I'm talking about clothe yourself, bathe yourself, feed yourself, dress yourself, all of that. So when you're thinking of that infinite banking mindset, you got to also think like, dang, I am now at an age, or even not at an age, maybe something, God forbid, happened, and I can't do these things. I can't do 2 out of 6 things, like bathe myself and feed myself or dress myself. Well, at least I got money sitting in my family bank that I established that I now have the ability to access, okay, and be able to use in certain ways to not only make money off the same dollar 2 or 3 times over, but some of you who have been on the call, where I can also use the same vehicles to even eliminate debt at the same time while my family is protected. And I didn't have to go get a second job. I didn't have to struggle. I was able to do all of this by learning the power of what it is that I have in my hand and maneuver accordingly. Okay. And so I just wanted to just share all that with you. You might have been looking for something a little bit more about how I can flip this money and do this and that. I can't give that to you. Why? Because we have to look at your specific situation to understand how you really need to maximize this type of um, powerful vehicle to be able to accomplish what it is you want to accomplish. Because everyone has a different goal and a different mindset. So any anything that you want to accomplish can be accomplished. We just got to know how, because how you may want to use it, how Anthony may want to use it, may not be how Alex wants to use it. Okay. And how Alex wants to use it may not be how Jessica wants to use it. And we have to determine how we're going to be able to use that to really maximize it. So you really truly can capitalize on what it really means when we talk about infinite banking. So I know, Christine, I probably went over, like, I know I started late. I think I came in on like 1 o'clock. So I just want to stop right there and give anybody an opportunity if you have any questions or anything specific you want to talk about. Yeah, so thank you so much, Christina. And also, real quick, is that Latasha? I don't know if that's look, I was going to say my Latasha as if she belongs to me. She don't, but my client Latasha. So I didn't know if that was her or not, or if it was someone else. But if it is Latasha, hey Latasha. And I think Ronald, you have a question?
Yes, I do. Um,
Hello.
I done heard a lot of pitches about infinite banking, and every time I get to this part when it says, "What about age? Do age matter?" And every time I look at somebody try to quote me a policy, I'm 68, so they try to quote me a policy, and some of them have the death benefit real high. The policy is crazy. Then I say, no, give me the lowest death benefit where I can do my own infinite banking. And it's never in my favor. So years ago, I had term, and after it expired, I said, I'm betting on me to make the most money that I possibly can. So it worked out in my favor. So I'm self-insured, but still, this concept sounds good if I would have applied it when I was younger. But as you get older, I don't see how it works unless you got a solution for that.
Yes, sir, I do. So what you described is the typical way that, I don't want to say the way that typical agents operate, because I don't want to say like it's a general practice, but what we talk about is about structure. Okay. And so what
Mhm.
you just mentioned to me is I, Gerda, want a max, I want max cash accumulation and I want minimum death benefit. Okay. Why is that? Because you're saying I want my money to really be working for me and I want some coverage, but I don't need the maximum. And what you mentioned to me is where they gave you max death benefit and minimal cash accumulation. And I'm going to be very
Mhm.
honest. Why do people do that? Why do agents do that sometimes? They
Fat in
do
their
that
pocket.
their pocket. You got it right. And so that's why it is critical for you to have someone who operates with integrity, because once they hire you that higher amount, it's like, oh yeah, get this, because it's more in their pocket and especially based on your age. Okay. And so what happens though, in all honesty, because you are 68, for instance, if you got a policy, that just means majority of your funds would be, and I don't even want to say majority, I digress. Why do I say that? Because I have a client who's 68. And what do I mean by your funds, the accumulation or the segmentation? So I'll break it down. Where he is 68, he does $300 a month. Okay. Out of that $300 a month, I think about $100 is paying for his death benefit. Why? Because you have to still pay for the insurance, right? And so what is that? 1/3 of his policy, of his premium, of that $300 a month is his premium. 1/3 of that
Mhm.
is paying for his death benefit. It has to, because he has to pay for the insurance. The remaining 200 is going into his cash value. Okay. But the makeup of his payment is 2/3 is going cash value, 1/3 is going to death benefit. Okay. I have another client who is 67. where the makeup of their funds, I don't remember exactly their premium, but I know the makeup is 50-50. Okay. Where that basically means, let's say they're paying 200 a month, 100 is going to cash value, 100 is paying for death benefit. What determines that is all about demographic and how much they're funding it. That would determine the makeup. Now, what you described is the person probably came, you went to them, you wanted to do it. Let's just use the 300 for my same, like my 68-year-old client. That person made your 2/3 of your money pay for the death benefit, 1/3 pay for the cash value. So a person your age can still benefit for these type of policies, but in all transparency and full transparency, because you are 68, one of two things would need to occur. You either would now need to fund it a little bit longer. Why? Because you're starting later. And you might say, look, I only want to pay into this until I'm 78, 10 years, for example, right? So now you're starting later. So it becomes, okay, Mr. Ronald, and you might say, Gerda, this is my ultimate goal that in 10 years, I want to kind of have this kind of, cushion. And I'm going to have to be honest with you. Okay, Mr. Ronald, yeah, but you said, for example, I just want to do $200 a month, Gerda. Well, Mr. Ronald, your goal that you're trying to reach, it's not going to get there. Okay.
Okay, but
Especially, hmm?
can can I inject a little something?
Yep. Yep.
Because you talking small numbers, but say for instance, I want to put away two, three, 500,000 into a policy, but they got restrictions. They telling me there's a max or mid or max or something. They got restrictions where I can't pile that money away. So it becomes like if it's a third on that 500,000, that's a lot of money I'm throwing away at my age. I'd rather reinvest it and let it make money, and that's so far I've been doing it without a policy because it's not to my benefit or my heirs if I did that. Now, if it's a policy that I can put on some of the younger members in my family or trust or something, then I'd be interested in that, but not on me or my wife.
Yep. So I like how you talked about like the larger numbers, right? So
Mhm,
with that, let's say you're like, Gert, I got 500,000 I want to tuck away, right? So number
mhm,
one, if you dump that 500,000 into the policy at one time, that's what we call a single premium, which means you just put it in there and you done. You ain't never paying nothing else on it. Well,
mhm.
that policy becomes immediately what we call a MEC. And a MEC is a modified endowment contract for anyone on the call who doesn't know. And what does it mean when it becomes a MEC? It just means it transforms your policy, which is a tax-free, tax-deferred vehicle. It basically transforms it into a taxable vehicle like a 401k or a 403b. Okay. But it may not sound as crazy. It sounds crazy, but it's not as bad as it seems because there's a lot of investors who it goes a little bit deeper into how that is calculated because it's only you pay taxes on the gain. Okay. So that's one. So if Mr. Ronald came to me and he's like, I got this 500K I want to tuck away, but I don't want to hit the MEC. Okay. Well, what would happen is we would then have to put it in what's called a PDA, which is a premium deposit account. Okay. And what the premium deposit account basically does, if let's just say we're talking about the IUL, right? The premium deposit account is you giving the insurance company the 500,000 that you have in your hand. You're telling them, look, I don't want it to be a MEC, but I'm gonna give it to y'all because I don't want it in my hands. What they're going to do is they're going to then ask, okay, Mr. Ronald, how do you want us to split up this 500K between 4 years up to 10 years? So the lowest you could do is 4 years, where you could spread out that 500K. The highest you could do is 10 years. Let's just say you said 4 years to make it easy. What is that? 125 a year? Okay. So what they'll do is they'll take that 500, they'll put it in that premium deposit account where you are earning interest on the money while it's sitting there. So let's say 4 or 5% is sitting in that PDA account. The first year they take out 125, they put it into the policy, right? The segmentation of whatever goes and pays for the insurance, whatever goes in the cash value goes there. Let's say though, what is that? 375 that's still sitting in that PDA account, it's earning interest. Okay. So next year when they move the money over, they're moving whatever you had in there, the 125 plus whatever interest you earned. Okay. Now, with that, what does that do? even though you dumped in the 500 at one time in that PDA account, not into the policy, because remember, if you dump it into the policy, it's a MEC, which makes it a taxable vehicle. But even if you give them that 500K and they put in that PDA, that 500, and they're spreading it out over 4 years, that 500K may have just purchased you a few millions of dollars of coverage. So even though you might be like, Gert, I got this 500K sitting here that God forbid if I'm not here no more, the family gonna get 500K, and I'm good with that. But if you put the 500K here and you spread it out over the 4 years, we would have to put in your actual numbers, Mr. Ronald, to see like what's the makeup, right? And my clients on the call know if it's more than 50-50 or it's getting something crazy, you might be like, I love it, Gerda. I'm gonna be like, I don't like it. Okay. But once we do the breakup, let's just say you put the money in, you put the 500, it purchased you. I'm just throwing a number out. I don't know until we put your actual numbers in, but let's say it gets you like $3 million in coverage. That money is still there for you to be able to access over the years, right? While your family now, if you would have left that 500K sitting there and you're like, hey, the family could take it and they could go, or I can invest it and make some more money back. You're right, right? You could put it in there, right? You could take a big risk and have a big reward, but you can also take a big risk and lose big, right? And I'm very conservative and old fashioned in how I am, where I like to hold on to more money than bet on the winners. I like to reduce my losses. So now that 500K that you put in there, that's earning interest, that's protected, is spread out over the 4 years, it just bought your family millions of dollars of coverage. So God
But
forbid
what
something
if,
happens. Mhm.
but what if, what did that cost me though? You know, if you only taking the 125 out each year, I'm still gaining. It's a compound interest for 4-5%, right? Now,
No,
what is that premium costing me for that
no.
insurance policy?
And let me back up. So the compounding interest is what you're earning if it's tracking the S&P 500, that's what you're earning your cash value. What's sitting in that PDA account, okay? Remember that PDA account is because you didn't want to dump all of it in at one time into the policy. Why? Because you don't want to hit a MEC. But when it's in that PDA account, they're giving you a fixed interest rate while it's just sitting there waiting to move over. But once it goes into your cash value portion, and let's say it's tracking the S&P 500, if the S&P 500 make 10%, you just earn 10% on what's in the cash value, what's already been moved over. Okay. Now, what's over here is the rest that's sitting in that PDA waiting to be moved over. That right there, that is earning that fixed interest rate. What's over here is earning whatever the S&P 500 has returned. Okay. And then you had a second piece that you just said, Mr. Ronald, that you said something and I wanted to circle on it too. What did you just say? It kind of slipped my mind.
Um, far as the interest on the one account, that's all I'm gonna earn 4 or 5%. But then on the other side, with that 125, what would that actual premium cost me?
Oh, the premium, we won't be able to determine it until you and I sit down because I have to put Mr. Ronald down. So I have to say a 68-year-old male who has 500,000 that he wants to put into a policy, and his goal is cash accumulation with minimum death benefit. You and I have to sit and then we will look. And anyone on the call knows I share my screen. So you're looking at me plugging in your numbers and we're seeing what it's going to produce. So I
Okay,
wouldn't even be
sir.
able to tell you. Mhm.
Okay, I understand that. But what if, is there a better way or a smarter way to, if I just assure another one of my kids or I don't know, grandkids, would that be a better way than just trying to assure myself?
Well,
Because
it all just
I'm
depends.
looking at a trust, I'm looking at it for generations past me. I'm not really concerned with me. I'm really
Yeah.
concerned that let it grow for generations.
Okay. So if your goal is I want to provide insurability to those my heirs, right? And make sure that I kickstart these different things for them. Let's just say like your kids or grandkids or things like that, right? Well, what would have to happen is, yes, you can do that. You have to have some type of insurable interest, which you would, because these are like your kids and grandkids, right? If they're your grandkids, what would have to happen is the parents would have to sign off on, which wouldn't be an issue, sign off on, okay, yes, their grandfather can go ahead and get this policy. The other thing, though, is that we would have to, the parents would have to be insured up to a certain amount that cannot be less than what the kids are. What does that mean? So let's say you have this 500K, you got 5 grandkids. So 100K for each grandkid. I'm just throwing a number out, right? That you're like, I want to dump this in and do this way. Well, what would happen is, because they're so young and that amount is so high, that's going to be able to afford them a high amount of coverage. Let's just be honest. It might be in the millions. Who knows, right? I don't know. But let's just assume it's $1 million. Well, if their parents or each parent is not insured with $1 million or more, you won't be able to get that much starting out for them. Okay. So it cannot exceed what the parents have. Why? That's just a stipulation. You know, insurance is a safety measure for anyone who doesn't know. You don't want the having more insurance on the kids, and God forbid something happen, parents collect. Unfortunately, that's a reality. So what
Right.
would have to happen is that we would have to look at how much are the parents insured? What is it Mr. Ronald wants to do for his grandkids? How much? How old are the kids? Because even though, let's just say you said, I want to give 100 for each grandkid. And let's say you have a 2-year-old grandkid, a 17-year-old, and a 25-year-old, for example. Well, and let me back up. You have a 2-year-old, and because I want to keep in the minor ages. You have a 2-year-old, a 10-year-old, a 15, a 17, and a 12. Okay. Well, and they're all siblings, all 5 of them. Well, what would have to happen is, if you say I want to give 100 to each, well, trying to do 100K for a 2-year-old is going to have a higher amount, a higher death benefit, because they're younger and you're putting so much more in. But because they're all minors and they all have the same parents, you cannot get more coverage for one minor than the other. They all have to have the same amount. So now it becomes, okay, what is the amount that this insurance can afford that has to be equal across all the kids as far as the death benefit goes, that also doesn't exceed what their parents are insured for? So let's just say their parents has 500,000. So for everybody here, the parents have 500,000 of death benefit. The Mr. Ronald wants to do 100,000 for each kid. We determine out of all of that 5 kids, they're all minors. The most that they can get is 500K, and let's just say the 100K affords them that coverage. Well, the 500K for the 2-year-old is not going to cost the same that it's going to cost for the 17-year-old. What do I mean by that? Which means if Mr. Ronald pays that 100K, and let's just say you break it up into 10 years. Okay, because remember, you don't want to dump the whole thing and it become a mech. So that's $10,000 a year, which means this $10,000, when you put it in there, it might cost, I'm just throwing a number out. It's not, wouldn't know till we put your numbers in. This 500,000 death benefit for the 2-year-old might cost $200, which means when Mr. Ronald pays his 10,000 every year, they're going to take 200 out, pay for that $500,000 death benefit for the 2-year-old, and the other 9,800 is going in their cash value. Whereas in the 17-year-old, that 500,000 worth of death benefit may cost, I'm just throwing a number, 400. So every year when Mr. Ronald pays 10,000 for the 17-year-old, that 400 is going to come out to pay for the 500,000 death benefit the 17-year-old have, and 9,600 is going to go in their cash value. Does that make sense so far,
Yeah.
Mr. Ronald? So
Yeah.
we're speaking off we're being speculative, but we would have to sit down and I would have to say, Mr. Ronald, what's your goal? What do you want to do? Who is it that you want to insure? Do you have the insurable interest? How much? What is it that you want to accomplish? And I'll give you an example. My daughter's 17. My goal is she wants to be a doctor. She said when she was younger, she wanted to be a real estate investor and a doctor. So I told her, I said, okay, I don't know. Y'all heard me. I don't know much about real estate, but what I do know is I can get a quadplex with a single family home. Our plan is in 10 years, we're going to take out, let's say 30, 40,000. She's going to have over 6 figures. We're going to take out 30, 40,000. We're going to go buy a quadplex, put it down on a quadplex. The trust is going to own the quadplex. We're going to rent out all 4 units, or she's going to live in one and we're going to rent out 3. When we're getting the monthly rent payments, we paying the mortgage. The rest of it, we paying the policy loan back. We paying back that 30, 40,000 we took back. Because why? Because I'm filling my cut back up. And then let's say it takes us 2 years to fill our cut back up to pay that 30, 40 back that we took out. In 2 years, we're just going to take 30, 40 out, wash, rinse, and repeat. We already earning interest. We're going to take that 30, 40 out and we're going to go buy another quadplex. Because I don't know much about real estate, but I know something about you got to stay somewhere for 2 years and something, something, something. Whoever's good in real estate and you're an investor on here, great. You know the information, I don't. But that's the play. So I would have to sit with you, Mr. Ron, and say, what's the goal? You might say, okay, well, I want my 17-year-old when he's 27. That's my plan. Or the 12-year-old, I want to do this. They want to go here in robotics. We want to send them off. We got to talk so we can see what does the numbers look like and what would you have to do for us to be able to accomplish that. So I know that was like a lot, but again, it was just a lot to say we would have to talk.
Okay, well, we'll get together because I want to be respectful and give
Okay.
other hands is up. I want to make sure they can get their questions answered.
No,
So
absolutely. Well, it was nice
definitely,
talking to you.
right. We gonna talk because I got a different situation than most. So
Yes, sir.
we'll I if is there a way to set up appointment, I'll do that.
Yes. I think
Okay.
Christina or her team is going to drop the link in the chat shortly, or they may have already dropped it. I'm not sure. I don't know if Christina's still on the call or not, or she stepped away, but I think they're going to drop it in there. Perfect.
Okay.
All right. It's nice talking to you.
Likewise.
Thank you. And then I am going to go with Eric, Cairo, and Chris, and then Ola in the chat, and then I will have to drop. But Eric, how are you?
The link is in the
Hey,
chat.
okay.
Oh,
Eric's like,
you may have
okay.
to drop it again because you may have to
Okay.
drop it again, Christine, because I don't see it.
Okay, I will.
Thank you. Hello, Eric. How are you?
Hey, how you doing? Can you hear me?
I'm doing good. And yourself?
I'm pretty good. I'm pretty good. So if I'm working as a paid contractor, right? Um, and if I get injured or I need to be on disability, do I still use my insurance policy or do I insure myself when it comes to working?
So that's a great question. I'm happy you brought that up. So you always want to have insurance, right? Medical insurance, right? Especially if you're a contractor, get something if you need to go to ER, urgent care, something like that, right? To be having some coverage
Mm,
because the medical expenses pile up. Now, that is different from what you have in your living benefits. So I'll give you an example to make it easy. So God forbid you're a general contractor, you hurt your leg, right? It's not necessarily a
hmm.
disability. You just have to go to the urgent care or the hospital or something like that. Well,
Right.
that's why you need medical insurance because it's going to cover those costs. And if that injury is not something that's considered a terminal illness or a critical illness. It could be a specified depending on what type of injury you sustain, but let's just say it's not a critical, right? Meaning critical
Hmm.
just means you can't do 2 out of the 6 things of daily living. Okay. Which means, God forbid, you can't clothe yourself, feed yourself, bathe yourself, wipe yourself, dress yourself. Those are the things of daily living, right? If you can't do 2 out of those 6 things, then you can tap into the death benefit, and the insurance company will give you an
Mm,
advance of that. But if you just hurt yourself or you like, dang, I'm out of work for a couple weeks, and I can't do this, that is something that would then be determined because it's like he's just out of work for a couple weeks, right? Is this something that
right.
is to be afforded? The other part of that is when you first get your policy, you have to, and again, we would have to put your numbers in and see what it looks like. Let's just say, I'm just gonna throw a number out. Let's just say you're 35, okay? And you got the
Hmm.
policy when you're 35, and God forbid something happens to you. Let me use somebody. I don't like using you exactly. Let's say Bob. Bob got the
Sorry.
policy 35, okay? And something happened to Bob the next year when he's 36. Bob has his policy that has living benefits that affords him an advance of the death benefit. Let's say Bob's death benefit is 100,000. But Bob has only had this policy for a year, and he may not have accumulated enough cash in it where it might show that if he has a critical illness, he may not be able to be afforded anything. But if he has a terminal, right, or specified, they might give him an advance. But because he's so early, they may not. But we wouldn't know until we put your actual numbers in there to see, would Bob actually be afforded something if something like a critical illness or a terminal illness occurred? And just to add additional context to what I just said for anybody here, when I talk about the advance of the death benefit, what I mean by that is, for example, a client had a policy, Bob got the policy when he was 35, okay? Bob now is 85 years old. When Bob got the policy, and you won't understand this until we actually sit down and you'll see it, but when Bob got the policy, let's say Bob got the policy and he got it when he was 35, it started off at 100,000. By the time Bob is 85, let's say his death benefit grew to 2 million, okay? All right. Bob now can no longer he can't dress himself no more, he can't feed himself no more, just 2 out of the 6 things. Well, the insurance company is going to say, well, Bob, because you can't do this, you're 85, you have a $2 million death benefit, and you got this issue going on. They will then go to Bob and say, if Bob comes to them or Bob's kids or whoever says, hey, my dad can't do this no more. Well, the insurance company is going to say, well, Bob has a $2 million death benefit. And because this qualifies as a critical illness, he can't dress himself or feed himself no more. We're going to give Bob an advance of his $2 million death benefit, which means we're not going to, this is where the living benefits come in, okay? Which means we're not going to wait till Bob passes away so his family can receive the death benefit. Remember, we talking about life insurance for his life, but that his family's going to get a benefit when he's not here. So they say to Bob, okay, you can't do 2 out of 6 things. So they may say, Bob, we're going to advance you. We can advance, let me back up. We can advance you up to 1.6 million. Why did I say can? Because it's Bob's decision if he wants to take the full lump sum of the advance the insurance company is willing to give him from the death benefit because of the living benefits he has in the policy. So why am I emphasizing that? Because these policies are not just about, everybody get excited about the cash value component and it's great. Me, I'm more excited about the living benefits. Okay. Why is that? Because I am going to age. Okay. If it's God's will and I reach a certain age, and let's say if it's God's will and I can't do 2 out of the 6 things anymore, and it is his will, so I'm not going to argue with it, at least something's there that I can be taken care of in my old age while I no longer work and I have something in place. So Bob can decide, you know what, give me the 1.6 million and I just want to do what I need to do with it. The insurance company will say, okay, and give him his 1.6 million tax-free. Okay. And then when Bob is no longer here anymore, his heirs get the 400K difference. Now, here's the piece I want to sit back and emphasize also and just go a little bit is why am I emphasizing that? Because, and give me 1 second. I know this is kind of like, maybe like unprofessional, but I am a single mom and my daughter is calling me and she has my car and I just want to pause and make sure she's okay. Okay. Give me 1 second.
Bro.
I'm sorry, y'all, but if you got kids or grandkids, she just called me asking me, can she go get some ice cream? And I gave her money last night. I don't know where it went. But the point is, Bob got paid out the 1.6 million, the difference of the 400K that's left. Remember, because he had a 2 million death benefit. They gave him an advance. They gave him the opportunity or the option to take the lump sum of the advance. The advance maximum in this instance was 1.6 million. Bob said, yes, I want the whole 1.6. So Bob is not here no more. They give Bob's heirs the 400K. The other reason why I'm emphasizing that is because not every insurance company does that. Okay. So all these things, when everybody think IULs and all the policies are all created equal, they are not. The reason why I'm emphasizing that is because there are carriers that same scenario, okay? Bob said he want the full 1.6. Bob's not here no more. His family's probably thinking, okay, we're going to get the remaining 400. They're going to say no. When Bob chose to get that 1.6, that was it. That's it. Bob took the money. Whereas in the carriers I work with, Bob's family is going to get the remaining 400 difference, while Bob was able to get the 1.6 while he was alive. And if he says, you know what, I know my maximum is 1.6, but I don't need all of that. I just need 300,000 to just make sure I'm set up straight and enhancements in the home and I'm good. Well, when Bob is no longer here no more, his heirs will get 1.7, the difference. So I hope that made sense. So for general contracting, for your physical, if you're like, hey, I need to go to the doctor, if something happens, you want to get medical insurance. If it's something where I need something in place as I get older, or God forbid, a full total disability happens, you will also be able, not only with your medical help with those medical expenses, but you'll also have living benefits that will be able to kick in at that time, depending on what type of medical condition you're going through.
Okay, one thing real quick. So let's say you're getting paid through your EIN, your trust, do the medical insurance for proof of work or anything like that? Or can I just have it just as a natural being to have medical insurance?
So repeat that I'm gonna repeat to see if I follow. Are you saying
Okay, so I'm working as a paid contractor, right? And I'm insuring myself, right?
mhm.
Um, I need I need medical insurance. So with the medical insurance, do I have to let them know where I got hurt, or like, or should I just ask them that question? I'm not sure if you even know the answer to that.
Yeah, I would say if you are self-insured, which means you're paying cash for when you go to the doctor and all of that. Is that what you're saying? And
Right.
okay, and then you're saying if I get health insurance and I got hurt, right?
hmm
Do I have to let them know where I got hurt and all of that? So that's the space of health insurance, okay? Not the life insurance. So that's the space of health
Yeah,
insurance.
right. Exactly. Yeah.
So that would all just depend on that will all just currently I do not do the side of the health insurance, okay?
Yeah, I will have
Um
to ask them
but
when yeah.
yep, you would ask them, but here's the
hmm
thing. It insurance is pretty much insurance, right? So the other thing caveat I want
hmm
to give you is every carrier is different. What one carrier
Okay.
may say, we don't need anything, another carrier may require. However, think of it like this: when you were working, you're a 9 to 5 or a W-2 employee. If you
hmm
paid your premium for your health insurance and you got hurt and you need to go to the ER, you just go to the ER, the doctor, and they tell you what your deductible is and what you got to pay. And you just pay.
hmm
It's a medical emergency. So
Okay.
the doctor's office will file the claim with the insurance company. The insurance company will pay their portion depending on what your deductible is, and you would pay, or if you have like a copay, if you have like a HMO where you have that set amount, and you just pay accordingly. Now, if you didn't go
Okay.
to the doctor, you like, hey, I ain't go to the doctor, but I paid $2,000 and there's no claim from a hospital or doctor, that's where you're gonna run into show me what's going on. So
Gotcha. Okay. Thank you.
you're welcome. All right, and then Cairo and Chris.
Hello, thank you for sharing of yourself and of this information. I can definitely empathize with the mother in you. My daughter called me while we was on a call, and it was to take her shopping after school. So first question
Yeah,
I had was, is this an emergency? And can I call you back? She said, yeah,
right.
and I did, and she wants to go shopping. So similar situations I can understand as a parent. My
Yeah.
question is with respect to something that Mr. Ronald shared. And I want to know if you would be opposed to educating us with maybe some red flag jargon. You used that word earlier. Because when I've spoken to agents, and I've spoken to a number of agents from different spaces, um, I, I'm not exactly sure what the red flag thing is. I typically go with my spidey sense. If this doesn't feel right, I'm not signing anything. I'm not going forward. Thank you for your time. God bless you. Good night. That type of thing. But I feel if we knew two, maybe three things to look out for. Earlier you mentioned something to the effect of front loading, maybe back loading, low cash value, high death benefit.
Yep.
See, that's something that I would probably ask. What are maybe two or three more things that we could
I would
utilize
ask
in
them,
order to say this person's on a take, or this person's legit?
yep. Yep. And that's a good question that you asked, because a lot of my clients, well, all my clients, the reason why I overeducate is because I always tell them, even though I have these hundreds of things that I know, as long as you hold on to one or two things and what happened to Kyra? Did he drop? I don't know. Did
No, I'm
he
here.
drop?
I'm here.
Okay. Oh, okay. Something happened. Okay. So even though I know the 100 things, you may not know the 100 things, but there's going to be one or two or three things, like you just said, that you're going to hold on to. And why do I overeducate? Because I'm in the business of life insurance, so I know tomorrow is not promised. But because
Mm,
I have a commitment to the people that I serve, why do I say serve? Because I'm not here to sell anybody. If you make an appointment, I know what you're here for. Well, I'm here to serve you. So now, in order for me to serve you, I need to educate you. And then while I'm educating you, you're going to grab two or three things that you're going to always hold on to be able to allow that generational wealth to truly pass. Why do I say that? Because you're here getting your trust and all of that. That's great. You get a policy. That's great. But it means nothing if you leave all this money to your family, to your daughter, to your kids, and they squander it or they don't have the knowledge to be able to keep it going. Okay. So I do all of that. So if I'm not here, my clients know. If you got to go, listen, Kara, you just say you had a daughter. If I'm not here anymore and you're like, okay, my daughter is now, how old is your daughter?
Laura's 15 years
15.
old.
Okay. Now your daughter's 25 and you probably got a policy for her when she was 15, but now she's making more money. She's an entrepreneur. She's
Hmm.
killing it. You want to help her get another policy. You want to go in the meeting with her. What I always tell people is, did they mention, ask them what's the MEC limit? Okay. Ask them, does the carrier that they work with have measures in place to prevent you from hitting the MEC? Why do I say that? Because, for instance, the carriers I work with, if you try to dump in extra money, they're not going to accept your deposit. They're going to send you documentation for you to sign and acknowledge that you know what you're about to do by overfunding this policy, that you know it's going to be a MEC. Once you sign it and you send it back, they still don't accept it. They reach out to me and they expect for me to reach out to Kyra and be like, Kyra, do you know what's about to happen? If Kyra's like, yeah, I want to put the money in, I know it's going to be a MEC, do it. Great. I
Mm,
sign it. I send it back to them. Then they say, Cairo, you can send the money back. We'll accept it. It will be a MEC. You signed it. I signed it. You acknowledged. You want to know what's the MEC limit, what measures they have in place for the MEC limit. You want to know, does the policy run to face? What does that mean? Some carriers, when they do illustrations, it runs typically from age 120 or age 121. Okay. I just looked at a young lady's policy the other day. She's had this policy for 3 years. It is a whole life policy. The policy only ran to age 60. Why do I say age 60? Because at the age of 60, her policy lapses. She has no money left into it. Why? Because the way the agent set up the policy, majority of the money is going towards the death benefit, and she has only $2 and some change going into her cash value. Okay. And $103 paying for the death benefit. That automatically signaled to me the death benefit is high, it's taking majority. After 3 years, this young lady who is 41, she got it when she was 38. She only has $98 in her cash value. Okay. So the
mm,
second question you want to ask them is, first was MEC, what's the MEC limit, and what measures in place does the carrier have in place to prevent it hitting a MEC? The second question that you want to ask them is, what is the allocation or the segmentation of what's going to my cash value versus what's going to my death benefit? Okay. And they could give that to you with just dollar amounts, kind of the example I gave. You're paying $200 a month, for instance, $30 might be paying for that death benefit, 170 is going to your cash value, right? You want to ask them what's the allocation, because what you don't want is 170 is paying for the death benefit and 30 going to the cash value. Some agents might not tell you outright what that breakdown is, but the way that you can pick up on it and say, well, this ain't gonna work for me, is you ask them how much, let's say they were like, okay, Kyra, this is 500,000 or this is 250,000. And you said, I want to do 300 a month. And you ask them, well, how much is that? What is it? 250,000 going to cost me? And they might say, oh, okay, well, since you're doing monthly, it's going to cost about $203. They're not going to break down and say, and only 97 going to your cash value. They might not say that because they know that they're going to
mm,
lose. So they just might say, it's just going to cost 203, but immediately, hold on. The death benefit cost me $203. I'm only paying 300. That means only 97 going to my cash value a month. Now you could circle back and ask them, so does that mean 97? So how much is going to my cash value? And let them talk. Okay. The other thing I would say is to ask them, is there any wiggle room? Now, wiggle room is not mandatory, but I like to have my clients have some wiggle room. Why? Because you want to be able to dump in a little bit extra if you want to. You don't have to have a policy with wiggle room, but we know if I get a little extra, let's say I got a refund check from the IRS, which I ain't getting one in a while, but I'm looking forward to someday getting back to that space. But let's just say, but it was back in the day. I'm gonna be honest. Back in the day when I was younger, I had my daughter. I used to bank on refund. I used to be like, oh yeah, I'm getting about 3,000 this year or 2,000. But let's say I was still in that space. Well, for me, my mindset would be like, well, I want at least wiggle room of about 1,500. So when I get, because it's you telling me, so when I get my refund check, I want to be able to dump it in each year. Okay, that wiggle room would allow me to do that if a person anticipates they're going to get some extra funds each year to dump in. So you just ask them if there's wiggle room. Now, if they tell you there's no wiggle room, that's okay. That doesn't mean they're shady or anything, but you can ask them, well, I would like some wiggle room to dump in a little extra, but then it's going to be up to that agent to sit down, and I like to say the kitchen because I gave the analogy, I was the chef. Now it's up to the agent to go in the kitchen and cook, because we now have to figure out, is Cairo flexible with his 300, or did Cairo say, Gerda, 300 is my number. I can't budge from that, but I do need about 1,500 wiggle room. Then when I go in the kitchen and cook, I'm gonna be able to come back to you and say, Cairo, I was able to get you that wiggle room of 1,500. Out of the 300, you're still have a good sufficient amount going in cash value, okay? But, and it works, right? But I might come back and say, Cairo, I know you want 1,500 wiggle room, but in order for me to give this to you, I got to keep bumping the death benefit, because you say you don't want to go past 300. And if I keep bumping the death benefit, more is going to be taken away from the cash value, right, to pay for the death benefit. Now, it's not always a bad thing, because I have a lot of clients with wiggle room. What that just means in simple terms is, if Cairo was paying $300 a month for $100,000 of death benefit, right? But out of that 300, let's say $40 is paying for the 100,000 of death benefit, 260 is going to cash value, okay? No wiggle room. Cairo then says, Gerda, 300 is my number, but I need at least $1,000 of wiggle room each year, or let's say 1,200 of wiggle room each year, which equates to, if Cairo wanted to dump in an extra $100 a month, 100 times 12 months is 1,200. That's how I got that. So let's say Cairo wants to be able to have room to dump in an extra 100 if he wanted to monthly. Okay. But he says 300 is his number and he needs $1,200 wiggle room. He's not budging from 300. Well, then I'm able to go in the kitchen and say, well, Cairo, before, when you had 100,000 as the death benefit, $40 was paying for the 100,000 of death benefit. 260 was going to your cash value, no wiggle room. Now you're telling me I don't want to budge from the 300, but I need $1,200 wiggle room. Then I have to say, well, Cairo, I have to bump up the death benefit. So no longer is it 100,000. I now have to bump it to, let's say, 125. So now it's 125,000 is your death benefit. But Cairo, since I bumped it to 125, it's going to cost you $50. Which means every time you pay your $300 a month, instead of the 40 that was being taken out when you had no wiggle room, you got wiggle room now of the 1,200. Your death benefit is now 125, but that 125 costs you $50. So now when you pay your 300, 50 is paying for the 125 death benefit, 250 is going to your cash value. But Cairo is like, oh, that works for me. Why? Because majority of your money is still going to the cash value. Where we run into that issue of that, I don't know if this is a good idea, Cairo, is if I had to bump it so much and you were like, Gerda, I can't budge from 300, and I had to bump it so much that now 150 has to pay for the death benefit, and 150, and actually let me back up, 50-50 is okay. So if 150 paying for the death benefit, 150 going to cash value. Why is 50-50 okay? Because the older you are, sometimes we run into that 50-50 and their budget, right? But where we get into that, Cairo, I don't know about this, is if, let's say 160 had to pay for the death benefit and only 140 is going to your cash value. Now more Even though you're probably like, girl, it's fine, it's only $20. I don't like it because more is paying for the death benefit, even if it's by $20, and 140 is going to your cash value. Does that make sense?
That makes sense. All of
Yeah.
it makes sense.
So I hope like I said, I over educate. So I hope that made sense.
Hmm. Yeah, I have the questions too. I feel more confident speaking to these people and keeping up with it because when people start talking fast, man, I slow it down, bring it down to my speed. Now, at least I have a um portion of the foundation that I can use to just to see where this person's heart is, right?
Yeah.
Is a heart laced with dollar signs? Okay, then maybe you should go and get yourself another person,
Yeah.
right? But if they have my best interest in mind, then they should be able to answer these plus give the examples that you just shared. So thank you again.
Thank you. And thank you for letting me use you as an example. I know I kind of uh, you know, wore your name out in the conference, but thank you so much for letting me use your name in my examples. I appreciate it.
That's fine. You're welcome.
Thank you. And then also Mr. Ron, you can reach out to my assistant. He's on the call. It's Damiel. So you could just send him your information directly and we'll add you. So even when you book the appointment, we don't send any like informational things and things like that. But you do get appointment reminders. So you can use the booking link that's in the chat. And it's going to be the same process whether we manually add you or whether you book an appointment through the booking link. Okay.
Can I respond to that?
Yeah, go ahead. Mhm.
Okay, I tried to book it, but it would not accept it if I didn't click on those approved marketing, and it wouldn't allow me to book the appointment.
Yep. And those are required for compliance reasons because let's just say you book your appointment and you miss it. And I have to confirm that Mr. Ronald didn't show up to the appointment. It does send you an email saying, hey, Mr. Ronald, we missed you at your appointment. You need to reschedule. So we have to have your approval to be able to even communicate with you through text or through email about your appointments.
Okay, I did click that one, but then the next one was marketing, promotional, all that, and that's the one I didn't want
Yeah.
to do. Get my
Uh,
body with that.
you're in luck because I don't do marketing promotional. Just I
But
don't do it. Yeah.
it's in that link. It's the
No,
second
it has
requirement.
no, it has to be. It has to be for compliance
Oh,
reasons.
okay.
So just with legalities, when you're dealing with someone's phone number or dealing with communication, just like any of those things where we're getting your approval. So it has to be there. And also, I don't send any promotional information or anything like that. But with my active clients, I do send newsletters like updates. Hey, this is new. This changed. Just an FYI, so you know. The current policy interest rate right now is 5%. Last year it was 4, but I do that so I can have a way to communicate with my clients. So it is something for compliance reasons I have to be able to send you anything. But nothing like, hey, you should sign up for this and that. I don't do that.
So I can contact Donovan. He's on the chat.
Danielle, but you can still book whether we put you on manually or you book it through the booking link, it's still going to be the same thing where you're in our CRM system in order for us to even communicate with you.
Oh, okay.
Yeah. It's just easier when you do book it through the booking link because it's like less work. It just automatically plugs your information in and you're now within my CRM for me to be able to see what appointments are coming up and what needs
Okay.
you may have.
All right.
Awesome. And then Chris, how are you?
Very good, very good. I appreciate the time and so much knowledge you've given us. So thank you.
Thank you.
I just have two questions that I think you may have already answered, but one in which is I don't have any kids, but I'm just trying to figure out so I'm trying to get a policy for my nieces and nephews that I want to be a part of the trust. And so I'm just wondering, it sounds like their parents have to also have a policy. Did I understand that right?
Well, so if you have the trust and they are beneficiaries of the trust, then
Mhm.
there's an insurable interest between the trust and them, right? So the
Right.
trust would be able to, so there's 4 parts: the owner, the payer, the insured, and the beneficiary. So the
Mhm.
insured has to be the children, right? And then the trust would be the owner, the payer, and the beneficiary, right? And they would just be the insured. However, even though, because the trust is not a physical person, because
Mhm.
they have that beneficial interest, it still would need to be something like, what does the insurance look like for the parents? Right? So
Okay.
are these siblings, right? Because if they're siblings and they're minors, then they have to have that same amount of death benefit, but the
Mhm.
cost for the death benefit, even though let's say they both have 50,000, the cost
Mhm.
would be different based on their age. Okay. So it's something we would have to, what that cost would be, I wouldn't know unless I put like the demographics in. Are they boy? Are they a girl? How old are they? And all of that, because historically insurance is more expensive for men than it is for women, just based on the like
Mhm.
mortality rates and stuff like that.
Got it. Okay. And then my last one is, so I've seen and watched quite a few videos on the benefit of overfunding the policy up into the MEC limit. Is that something you recommend and encourage or?
hmm So
Okay.
what's happened is a 7-year pay test. So within the first 7 years,
Mhm.
you can go up to the MEC limit. Okay.
Mhm.
Now it also depends on different variables. Okay. Because I have seen where depending on someone's age, right, and not even their age, sometimes it's weird. It's depending on what their age or their demographic or their gender or whatever it is, or their state,
Mhm.
where you'll see where the MEC limit is a certain amount and it might not allow them to go all the way up there, probably because they're overfunding it on top, which means I have clients who do dump ins. They might say, "Girl, I got 10,000 under my mattress, but I want to do $300 a month." And they just want to they want to accelerate it by dumping that 10,000 in. Okay, that's no problem. But
Mhm.
when you have the policy, right, and you want to max fund it to the MEC limit, you
Mhm.
would be able to do that for the first 7 years. So example, remember how I talked about the wiggle room?
Mhm.
Let's
Mhm.
just say the wiggle room, I'm gonna give ABC numbers. Let's say a person says, I want to do $300 a month. No, let's do 250. They want to do 250 a month.
Mhm.
250 a month times 12 months is $3,000 for the year. Okay. Their wiggle room premium may show 4,200, which
Mhm.
means they have $1,200 of that wiggle room, right? Which is the 3,000 to the 4,200. That's that wiggle room of the 1,200.
Mhm.
Their MEC limit may be 4,500, for example. That means in the first 7 years that this person has this policy, they can do as much as, if all else equal, why do I say that? Because it might vary depending on the person, but typically
Mhm.
they should be able to do up to 4,500 each year for the first 7 years up to the MEC limit. And that's what we call max funding. Because you basically saying as
Okay.
much as I can put, I'm putting in. After
Mhm.
the 7 years, the most they can fund the policy is going to be that 4,200 wiggle room. Okay. Which is
Mhm.
4,200, which is why it's so important to have wiggle room. Because if you don't have wiggle room, let's say you don't have none, and that person had their MEC limit was 4,500, they could do up to 4,500 for the first 7 years. But after that, if they had no wiggle room and it just said $3,000.06. Why do I say 6 cents? Because we see that often when I use the illustration to educate people. The 6 cents means that's all you got. You got 6 cents wiggle room, which is no wiggle room, which means
Right.
after the 7 years, you can only go up to the 3,000 because you don't have that wiggle room. So I like wiggle room because after I max funded to the MEC, I want to be able to add extra over, and that can accelerate your cash value growth, can even double it. I did one with a client yesterday. They just added an extra, it came out to an extra 123 additional a month because they wanted to do 200 a month. And then I
Mhm.
showed them, well, if you decided to max fund it, that's about an extra $123 a month, which is $323 a month if you decided, I want to max fund it. And
Mhm.
that doubled what it would look like for them at age 65. So that
Okay.
all just, that's why you want to have that wiggle room. But yes, you want to max fund it. As long as you're in your working years and you can max fund, max fund.
Got it.
And
Okay.
I show people when we go through your illustration before we submit the application, I go through the illustrations and I show people like my screen, like if we max fund it, this is what it looks like. But if you decide I never want to max fund it, I just want to do my normal 3,000 a year, which is my 250 a month. I don't even want to max fund it. That's okay. The illustration is going to show us will it work if you just max fund it at how you're doing it? Can you illustrate it that it's going to work properly? And if it does, great. And if you want to accelerate, this is what it would also look like.
Nice. Okay. Yeah, I scheduled my appointment, and I'm looking forward to connecting here soon. So thank you.
Yeah, looking forward to connecting with you. Have a great day.
You too.
Awesome. And then I think that was it. And then I think Ola had a question in the chat. I know Ola said that I answered it before, but I think you had another one. Yes, max funding. Yep, and I think that was kind of what I also said, Ola, too. Max funding is over the 7 years because it's a 7-year pay test, minimum death benefit, max cash accumulation, and increasing death benefit. Increasing death benefit, to answer that for anyone who doesn't know, that just basically means that a person has their focus is cash accumulation. So we would start off at a lower death benefit. So kind of what Mr. Ron said earlier, the person gave him a higher. I could already tell the person gave him a level immediately off rip. Okay, which means that they started him off higher, and they probably didn't even just give him a level. It wasn't even a level because the level doesn't mean it's more necessarily, but they started and they did his illustration off face amount. Okay, which means I'm not focused on cash accumulation. I just want to see what's the most amount of insurance he can buy for whatever budget he gave them. So increasing death benefit just basically means that, and that's a lot of times what we set for what I always start off with. That just basically means the person has I like to call it a base amount of insurance. And then over time, that grows, the death benefit grows. For example, a person's base can be 75,000. Okay. Layman terms, 75,000 is the base. The person pays $200 a month, for example. $30 is paying for that 75,000. Everybody got me? 170 is going to cash value. Okay. Now, that $30 is always going to come out. To every time they pay their premium, it's always going to come out because it got to pay for the insurance, which is the 75,000 death benefit. Okay. 170 going to cash value, their premium's 200. Let's just say 20 years from now, this person's cash value has 200,000 in it. The person's not here anymore. Well, their beneficiaries are going to get the $200,000 that's in their cash value plus the 75,000 base for a total death benefit payout of $275,000. Everybody follow me? But this person has not been paying for $275,000 of death benefit for the last 20 years. If they did, their premium would be higher. They wouldn't be paying $30 a month, right? It would be higher. So increasing basically means that your death benefit is increasing over time. Why? Because your cash value is growing. And you always have that base, but it's combining the base to the cash value. But you're always just only paying for the base because the rest of it is going where? In your cash value. So I hope that answered it. Yes, CF. So when you book an appointment, and this is something Danielle Luther is also going to go over with you guys when you have your initial call with him. There's a financial questionnaire that has to be completed. And what that does is it just helps me get a better understanding of your financial landscape. Just like I said, I don't take everybody on as a client. The reason why is because I have to these type of policies are not something that you just go out on. You have to qualify for it, right? And so the reason why is because the insurance companies understand how powerful these products are. And so they don't just, you apply and you got it, right? So you will get a financial questionnaire. You want to fill it out in its entirety and be honest and truthful in filling it out because it helps me help you and also helps me help you understand and strategize how you can use these policies to, let's say you got a whole lot of debt. And you're like, I just need to protect my family. I need to do this. Well, I'm able to then understand how I can strategize with this person on how they can utilize a policy to pay off debt at the same time, okay, while protecting their family. And then this person might not have anything. And we just say, okay, well, this is your strategy. What's the goal? And we go through there. So you want to make sure you fill that form out. And if anything's missing, when we look over it, we'll be able to let you know. You're very welcome. So that is all. I did go way over. I know I said I was only going to do those 3 questions, but as you guys can tell, I never like to leave someone's questions unanswered, and I never like to be like, oh, we'll talk about that later. I always like to just be able to give the information because what one person may have a question is, someone else may also have that same question. So I always like to answer in full. But thank you all.
Thank you so much, Gerda. I want to thank you for coming into the community, pouring into us, educating us on these, on these wonderful insurance policies and how we could grow our money and protect our money and actually utilize it for the generational impact that we want to do. So we always value you coming in during the workshops to educate us because you are one of the beacons here, one of the pillars here in the wealthy trustee community. So thank you so much for giving us your time today. And I just want to tell everyone, connect with Gerda and her team because she is a wealth of information and knowledge, and you are in good hands. Okay. Another thing is go ahead and click on that link and book that call because your situation, financially or structurally is different from everyone else's. So you want to give her and her team the opportunity to have a glance at what you got going on. Okay. So go ahead and book that call. So thank you so much, Gerda. We appreciate you so much. And you have an amazing rest of your day.
Thank you, you too. Nice talking to you all. Have a good day.
All right, awesome. So we are going to continue Q&A. So if you guys have any other questions for me, I know that there was a couple of hands up. I will go ahead and answer your questions before we close out. So I see Eric has a question.
Yes, I do. I'm sorry I'm driving right now. I'm kind of all over the place. But
All right.
real quick. So for your
You,
FBO, how do you take the money out? Can you hear me?
yeah, you're breaking up pretty bad.
All right, this is better.
Yes.
It's better. I could barely hear you, but okay, it's okay. Um, for your FBO, when you get donations and things like that, um, how do you take the money out? Basically, the donations.
Well, what do you mean? How do you take the money out? So you either spend the money within the trust or you pay for services from to another entity, or you take loans out of the organization.
Okay. Um, so when it comes to real estate, right? Um, it's a possibility I can create a my own faith-based building and just have multiple members as tenants.
Yeah, they're not tenants. So documentation is important. So they're not tenants. So you can't look at it
I used the
as
wrong
a
word,
tradition.
but
I'm sorry.
I used the wrong word. I didn't really mean tenants, but as members living in
Yeah.
different.
Yeah.
Yeah.
Okay, yeah. So if you have an organization and you guys provide housing in your organization and you have members, and they provide donations, yeah.
And that's even if it succeeds over four, it still won't be considered commercial.
If it's over four, like, are you saying if it's over 4 units?
Yeah,
Yeah. So if it's over 5 units,
or 5 units. Okay, it's still not
yeah.
considered commercial
So
because
no. I'm not saying that. So I'm unclear as to what you're trying to say. So are you saying that the building is not going to be considered commercial if it's over 5 units?
yes, um,
No, it's still going to be commercial.
even if it's under my faith-based entity.
Yes.
Okay, all right. Um, I think that's it. Okay. Oh no, one more question. So the faith-based entity, it can't sell anything, right? Like merchandise or anything like that, because it would be profit, correct?
Correct. So you
If
you can have products or services, but it can't be for sale. It has to be an exchange through a donation.
right, so I can have someone donate money to obtain an item,
Correct.
right? Okay,
Yeah, like churches, right? Churches, they have gift shops, they have apparel, same thing.
holy water.
Everything.
Right,
Everything.
right,
So
right.
so just think about a church.
Mm-hmm.
Yeah, so you can do anything and everything that the church can do.
Okay, sounds great. Thank you, Christina.
You're welcome, Eric. Next we have Maria. Hey, Maria.
Hi, Christina.
Hey.
I have three questions. That are pretty cut dry. So one of the question is, do I need a website for all three entities, or is it just for the faith-based and the business? Or is
You
it
don't
only when we want to get
know.
finances?
It depends on how it depends on how you're going to operate it. So you don't need a website for your family trust, and most likely, depending on operation, you'll need one for your business. If it
Mhm.
is, a public facing entity, and then it depends on how you operate your nonprofit if you need one or not. So
Okay.
some of our community members, they do stuff publicly and they have a .org.
Okay. And then the second question is, can I use my sole prop as a third party entity when I'm applying as a grantor for the business in the FBO or any of the three entities?
So your sole proprietor is you. So
Mhm.
if you use that as the grantor, it's going to look like you.
Okay, but the EIN will be different than my regular social security.
Correct.
And if I used to run a business through my sole prop, is it still a third party entity or is it not?
Okay, can you say that again? If you decide to run a business through your sole prop,
No, so I have used my proprietorship as my business in the past. Um, but as I'm going to apply for the business trust and well, all the entities online, remember it has where you could put the social security number or you could put a third party entity.
yeah, so it's only social or tax ID.
Mm-hmm. So an EIN number is not considered a tax ID number?
No. A tax
Okay.
ID number is a tax ID number. A social is a social, a EIN is a EIN.
All 9 digits.
Correct.
So they will give me a problem if I do it as an entity.
Yeah, so you have to contact the IRS if you want to be able to use an EIN in order to apply for your other EIN.
Okay. All right. And then my third question is, do you suggest getting an individual trust, like as if it's a sole prop, individual trust in your name?
Yes.
Okay.
All right. Thank you, Maria.
No problem.
Next, we have Ronald. Hey, Ronald, how are you?
Pretty good, pretty good. My question is, I have a holding company that has four LLCs. Do I have to do amendment on the four or just the holding company?
Just the holding company. So if the holding company is going to remain the owner of all 4 of your LLCs, and then your business trust is going to be the owner of the holding company.
Okay. Also, too, I have a self-directed 401k, and in that self-directed 401k, it has a LLC. Can that be put into the family trust?
Yes.
Okay.
All right.
That's
Thank you,
it.
Ronald. Awesome. All right. Next, we have Andres. Hi, Andres.
Hi, Christina.
How are you?
I have a, I don't know if it was answered or not, but with regards to the quitclaim deed, um, I noticed when you were doing it that the part about the trustee you deleted. Can we do that, or does that need to be in there? Does that need to be actually on the document that noted who the trustee is? So it was something, I'm not looking at it right now because I had to go in my car, but it was something about for contact, the trustee or something like that. Or
Yep.
does that even need to be on there?
So it depends on the county. Some counties require the trustee's name on it and some don't. Everything is county specific when we are talking about the quitclaim deed. So generally, it doesn't have to be on there. Generally, I've seen
Okay.
it to where 1 or 2 counties where they require it,
Okay.
or
And then the other thing
they
is,
won't,
oh, go ahead.
or they won't record it.
Okay. And then if their county requires 2 witnesses, that doesn't make a difference either, right? You just add that to the document.
Correct. Yep. You just add 2 signature spots. Absolutely.
Okay. And then I don't know, I my that well, if you don't know, it's not a big deal, but when you do an S corp, they're pretty specific as far as what types of trusts can actually be owners. It's very specific. Um, and do you know anything about that? Because I mean, I was going on there, and they're clear about how the trust can only be 4 different types of entities. One of them is like an elected small business trust, and there's like something else and something else. And they're trying to really make sure that it's a not you a trust can't be a non-taxable entity. But I mean, do you know anything about that?
Yeah, so I don't know like the specific verbiage, but our business trust is eligible because it is one of the trusts that does pay taxes, and it files the 1041. So the unincorporated business trust is eligible to be a shareholder for the S Corp and the C Corp.
Okay. All right. That's good to know. Thank you. That was it.
You're welcome.
Yep. Thank you.
Awesome. Next we have Renault and Keela. Uh
Hello?
Hi, how are you? Did I pronounce your name correctly? Is it Renault?
You pronounced my name correctly, but my
And
wife goes by Kyla.
Kyla. Okay, got it, Kyla. Yeah, I
Yeah,
kind of felt like it was Kyla too. Okay, awesome.
that's all
Nice,
right.
nice
How,
to meet you guys.
nice to meet you as well.
Thank
Um,
you.
one of the questions I wanted to ask was, do we need to have 3 separate bank accounts for each trust?
That's a fantastic question. So yes, you want to avoid commingling. So you don't want to use business trust funds in a bank account that's owned by the family trust. So you do need 3 separate bank accounts, and those bank accounts are going to be trust accounts that are in the specific names of those trusts. So when you go to the bank, you're going to let the bank know that you want to open up a trust account for an irrevocable trust. Do not walk into the bank telling them you want to open up a business account, because with the bank, business accounts are specifically for statutory entities that are on the Secretary of State. So you have to tell them, I want a trust account for an irrevocable trust. And that's the type of account that you're going to get for all 3 entities.
Awesome, awesome. So I heard you mentioning on yesterday like my income is a 1099 income, but my wife's income is W-2s. So are you saying that each one of both of our incomes need to go into our business trust account?
No, so I'm not saying that it needs to go in there. No,
Okay.
so you get to deploy your money wherever you want. Um,
Okay.
so if you want to, for example, we had spoke about donations. If you want to do donations, then you would transfer your earned income from your personal checking account that's in your name into the faith-based organization as a donation. So that could be one form of a transfer.
I see. I see. So, okay. And that's when you say we can um, donate up to 60% of our income to our,
Correct.
okay, okay. Um, let's see. Um, Now, the last question is when it comes to listing, is it best to list our business trust when we set up our business trust name? Is it best to set it up under a holding set? Because I heard you keep listing your business trust as holding as an example. Is that the best way to list our trust?
I mean, that's just one of my favorite words to use, so I do
Mhm.
apologize because I am biased, but you do have to understand that this entity is an entity that holds assets, and so that's why I always tend to just gear towards that term holdings, but you can call it whatever you want. So a lot of people they use enterprise, they use limited. They use corp, they use all these different, different terms, management, co. So you can use whatever you want. The one thing that I will tell you is to stay away from the word business. So do not use that term because then you're going to confuse the bank.
Okay.
Because I think that they need to open up a business account, right? So it is a trust, but you confuse them because they're like, okay, is this a business? And so they want to label it so much as a business because of the name that you decided to choose. So use something, very general so that it doesn't have to, have this conflict to where, because there's a couple of banks they'll do that, right? So they're like, hey, the name has business, but we can only open up business accounts for LLCs and corporations. So we can't even give you an account. So I've seen
Yeah.
those types of issues. And so that's why I tell people stay away from using the word business so you don't face those issues with these financial institutions.
Okay, makes sense. Sounds
Yes,
good.
sir.
Thank you so much.
You're welcome. Thank you so much. Thank you to you and your wife for being a part of the community, and nice meeting you guys.
Thank
You as
you.
well.
All right, awesome. Next we have Brian. Hey, Brian, how are you?
Hey, Christine, can you hear me?
Yeah, perfect. Loud and clear.
Okay. Yeah, going from earlier, you mentioned about when it comes to transferring cars to it may be best to place them in a separate trust. Um, Regarding that, which type of separate trust do you recommend? Would it be a business trust or a family trust?
That's a really good question. It depends on the use of the vehicle. If the vehicle is used for business purposes, put in the business trust. If it's used only for personal travel, then put it in the family trust.
Okay. And with it being in a separate trust, you could have, so like say if it's business, would it be a separate business trust owned by a main business trust if the car is
So
used for business?
yeah, so you can set it up like how you set up your original business trust. So it's up to you. So you can have one trust be the trustee of that other trust or the beneficiary of that other trust. So when we're talking about trust, we don't use the term ownership. So, so you just have to decide, you know, which position you want the other trust to hold within the trust that has the car.
Okay. And vice versa, if it was on the family side, if it's a car that's only used for personal side, same thing, but it'd just be one family trust. Uh, I guess is the trustee of the other family trust that holds the cars or vehicles.
That is correct.
Okay. All right. Thanks. That's what I needed for now.
All right, perfect. Thank you, Brian. Next we have MacArthur.
Hey, Christina, how you doing today?
What's up? I'm doing great. How are you?
Oh, blessed and highly favored.
Awesome. All day, every day.
Ain't it great? Um, so one of the things that came up today as I was working through the asset inventory was the asset that I was thinking about was firearms and ammo. Um, being that those, could have some liability associated with that, do you have any specific recommendations around that? Are those assets?
Yeah, so those are high liability assets, so you would treat it just like the car. Right? So anything that you feel is high liability, if you have a high liability LLC, if you have a high liability, vehicle, if you have a high liability weapon, you want it in a separate trust from all of the other assets that are low liability.
Okay, so there's nothing special that you have to do other than just segment them, the assets.
Yeah, if you want to, so if you know that you're putting a firearm into just its own single trust, you want to put additional provisions in that trust in respect to that firearm.
Okay, so that's just something that, I would have to craft on my own, or is there like, special trust that you could point me to? I'm
Yeah,
just thinking
so
outside the
so
box.
so we do have like a database of other provisions that you might need just depending on your situation. So the program is generic. If you have something specific,
Mhm.
like what you're saying, like, a firearm, or if you have like special needs, beneficiaries, things like that, then we can assist you with adding additional provisions. So just send an email to the team. So you can
Mhm.
send it to support at 7 Ways to Wealth, and then we'll be able to assist you with the additional provisions you need for that specific entity.
Wonderful, wonderful. This is amazing, Christina. You have, amazingly created an environment that is amazing. It's truly a gift. I think back to I saw your videos and you said I'm giving you all a gift. So get in, get in, get in, get in.
Yeah. Yeah.
Uh,
So you received a gift. You feel like it is a
yes,
gift. Yeah.
absolutely, 100%. It's a gift,
Yeah.
truly.
Thank
I mean,
you.
truly,
Go ahead, MacArthur.
yeah. I mean, I just was kind of going through, you know, the website and looking at the resources and like I started reading through the art of passing the buck and wow. Yeah, that expanded my mind. And oh, and I watched the video you had on the family crest. That's what I wanted to ask you about. Can you speak a little bit about that?
Yeah, I mean, I don't talk about that. We have educators that talk about that. So the educator that educates on the family crest,
Hmm.
you have to book an appointment with her directly, so that she's able to educate you on that. So I stay in my lane, okay? I don't go
Okay.
to talking about what Brian or Gerda or our CPA and all that stuff. So that's what they're
Yeah,
there
yeah.
for, and that's why we provide you with their contact information so you can talk to them directly.
Yeah. Wonderful, wonderful. Um, amazing, amazing. It's just truly a blessing. Um,
Thank
yeah.
you. Thank you so much. And I will tell you, I'll give you a quick disclaimer that the reason why I like to give gifts is because my birthday is on Christmas. So it's just always been like I've always been in that spirit of giving, but I just do it all year round.
Wonderful, wonderful. Well,
Yeah.
it has been received. Thank you so much. Thank you.
You are so welcome. Thank you so much.
Um,
I appreciate the appreciation. So thank you.
Excellent. One thing I did want to ask too, I received the email about the Forex piece. And it said something about you weren't able to sign up. Is that still the situation? I mean, can we sign up for it now, or do we still have to
No,
wait?
no, not yet. So, I will be transparent. So as soon as our current administration got into office, there was some changes to the regulations with our overseas brokerage, and so they put a pause in allowing US residents from opening up a brokerage account with our brokerage.
Okay.
So it's been on pause since January, unfortunately. And so they are working around it to accommodate us. And so they have to create another branch or division. They are a group, right? So it's called Plexi Trade Group. And so they own, within that group, they own several brokerages. And so they're creating another, because we're not the only US based clients. So they are working on, and they have a board of trustees as well. So they're working with their board to create a different version to accommodate us. So it's been something that they've been working on pretty much since February. And so we just have to be patient and allow that transition to happen so that they can open it back up for our community to, to be onboarded.
Okay. Understood. Understood.
Yep. So I'll keep you guys updated, but our Forex brokerage account is still fully functioning, operational. It's just that we're not allowing any new investors at the moment.
Okay. Okay. But once again, Christina, I just wanted to say today, I think that you're really a trailblazer in a space that many dare not to follow. So this is definitely an appreciation and, a big thank you to you. Um, you have I don't know that my words of gratitude can express the gratitude that I have towards you today. So thank you.
Thank you so much, MacArthur. I appreciate that so much, honestly. I'm glad that you took the leap and that you decided to go through the whole workshop and that it exceeded your expectations. So welcome to the community. We are so glad to have you. And we know that you are a wealth of knowledge and information, and you're going to just add into what we're building here, which is a phenomenal community of trustees.
Absolutely, I agree. And I am a generational curse breaker. All
Yes, absolutely. That is the truth. Thank you.
right, thank you. God bless.
You're welcome. God bless you as well. All right, next we have Nick. Hey, Nick. And Nick, are you available?
Yeah, did it come off? My mouse acting funny. It won't let me click. But hey, Christina.
Hey, I can hear you now. How are you?
I'm good. I'm good. How about you?
Wonderful. Thank you for asking.
All right. So I got a couple of questions, and they're back to the beginning things we covered. One was the vehicle thing. So if I have a company or my trust, and it's based in one of these other states, like Wyoming or Delaware, and I am transferring a vehicle to it, then would my vehicle have to be registered there?
No.
Okay. Okay. Cool.
Yeah, so
Okay.
your trust can own assets anywhere in the US and in all US territories. It doesn't have to be from that specific state, okay?
Okay, perfect. And then my other question was to the quit claim process. Now, so I have an inherited property, which is me and my brother. I was asking, would it be possible for me to transfer my portion of ownership into the trust? How would that work?
Yeah, so it would be owned partially by a trust and by a natural person, which is your brother. So absolutely. So you would have to quit claim it. You would have to do a quit claim from you and your brother's name to the trust in your brother's name.
Okay, okay. So,
You might
so
want to have
okay,
a conversation with your brother so that you guys collectively can create a trust and both of you guys are trustees and you put that property into the trust. Because if his name is still on the deed, then it'll still end up in probate, if anything were to happen to him. So you might want to consider him getting familiar with it so that you can create a trust for the both of you.
okay, yeah, yeah. That's one of those things. Like I don't know if he would or not. So that's why I wanted to know if I would be able to
Yes.
do that portion because but that would still save it as far as on my end. If I had creditors or something come after me at some point, they wouldn't be able to go after because it's not under my name. It would just,
Correct.
like you say, later if something happened, like it would go to probate in that instance because it's
Correct.
not fully in the trust. Okay, okay, that's fine. Okay, thank you.
All right, you're welcome, Nick. Thank you. Next we have Divine.
Peace again. Okay, so my question is, when you were talking about the vehicle, say the vehicle is being used for business and personal, is it, if it's under insurance as that right now, but there is a percentage split, would you say to have two separate trusts? Because that's high risk, like it being in the business and one for the personal as well, or family?
So no, so I would just put it under one trust. And if there's anything business related, I will put it directly under the business trust.
Okay, great. And in regards to the other special trust that you were speaking about, do you have a specific indenture or verbiage for FGTs that you utilize, or is it one of these as well that is kind of like the full verbiage of it? For foreign
What,
granting trusts, the FGTs?
well, yeah, what about it?
So is that one of the special trusts or this
No,
verbiage,
no,
one of
no.
the verbiages
No,
that we're using with?
Oh, no, no, no. So what I'm saying is that if you have anything, any assistance with any additional provisions that you need to put. And so what I said was special needs provisions for beneficiaries that, have special
Okay,
needs. Yeah,
okay.
I didn't say anything about foreign grantors trust. So
No,
if you need any help with any other additional provisions, then just let us know. We'll assist.
yeah, that was the question. I understood. I wanted to make sure it wasn't in addition to like special needs and like specialty trust, but you do recognize the FGTs. It can assist with that.
No, we do not assist with that.
Okay, okay.
Yeah.
Thank you so much. What?
So the program only has the three trusts that we went over, and we will assist you with adding provisions to those trusts.
Okay, so we can add some provisions to the specific ones that we went over during the workshop, though. That's doable. Okay,
Yeah,
great.
yeah. So you can customize it however you want. So you can add anything that you want, and you can delete anything that you want. So for example, we have a lot of community members that they're heavy into crypto, and so
Mm-hmm.
they add provisions that are specific to crypto. So that's just an example.
Okay, and which trust would you say that would be added into or be part of that verbiage? Would that still
Uh,
be the family or the business?
so generally it's in the business
It
trust.
would be the business. That's what I was thinking. Okay. Thank you so much for clarifying. I appreciate. Oh, one more thing. For weaponry, you were talking about weaponry. Would that be everything, not necessarily just firearms? What about swords and other things like that, customized? All of that can go into one trust, correct?
Absolutely, yeah. So all of your personal items that you feel are an asset, equipment, anything like that, yes.
Okay. Thank you so much.
You're so welcome, Divine. All right. Next we have, is that Sylvia?
Yes, that's Sylvia.
Hi,
How
Sylvia.
you doing, Christina? Thank you so
Good,
much for
good,
this
good.
training
You're
it has been, I can't even describe it, but everybody else has said so much, so it's just overwhelming, but it's overwhelming in a good way. Okay, so
yeah.
it's great. I'm really enjoying this. But my question was, I know the trust can own property anywhere, no matter what the state, but when you need to get something notarized, like when you're doing that quick claim deed, do the notary need to be in that state, or does it be in the state where the trust is?
Okay. So, I'm just trying to understand your question. So if you setting it up in a different state from where you are, it can be in a different state, right? So if you're
Right.
setting it, yeah, it doesn't have to be notarized in the same state that you've chosen as the domicile.
Okay. All right. And the other question was, we talked about the donation of people's W-2 or 1099 income. Now, can that, I know you said, I think I heard the guy said donation after is in the person's account, but can it be donated from their payroll department? You know how some jobs, I don't know if they do this or not, but I know when I was working, they will have on there that you could donate, like say to Red Cross. Can you put on there like donate to, they can put another company to donate to instead of Red Cross, like another trust or something like that? If the company would allow that donation?
Yeah, so that's payroll specific. So you would have to
Okay.
contact the payroll department.
Okay. And the other last question, master classes. So after this training is over, would you be sharing with us like all the assets that we will still have, like whenever the master classes come up on different subjects, will we get those notifications, or now would we get a different email also, for follow-up questions of that nature, or no?
Yeah, so you will get an email, a text message. We're going to put it inside of the Facebook as a post, and we're going to post it inside of the announcement section in the Telegram chat. So those are the 4 ways that we communicate when we have master classes and Q&A sessions. So next week,
Okay.
we're going to have a Q&A session at 7 p.m. Eastern Standard Time on Tuesday. And then we have a master class on Wednesday, the 14th, where one of our educators, which is a real estate investor that has 150 something properties, is going to come in and educate you on a specific investment strategy. So you will receive communication so that you could attend.
All right, thank you. That's it for me.
Hey, you're welcome, Sylvia.
All right.
Thank you.
Okay. Bye.
Oh my gosh. Okay, next we have Betty. You guys, I literally have 3 more minutes, so I'm so sorry. So I do have to wrap it up and get my little children from elementary school. So we have Betty, and then we're going to wrap it up. So I'll see if anybody else has anything. Hey, Betty.
Hey, Christina. I echo every positive things that have been said about you today. So I won't waste my time repeating it, but I concur greatly.
Thank you.
My first one is, can I put my S corp into my business trust with owning
Yes,
only
but
99%?
yes, correct. Yes, so it can't own the whole thing. So it does have to be a percentage of your choosing.
Okay, what would I do about the 1%? I'll have to remain. It has to remain on the state website.
Correct. Yep. Unfortunately, that's how it is with corporations, all corporations.
Okay. Okay. Now, do I need to set up a separate trust for my cryptocurrency, or can I put those into my business trust?
Oh
I know
yeah,
you.
so yeah, you can put your crypto anywhere. So a lot of people, they'll put their crypto in any one of the 3 trusts. The crypto can go in there. So you don't have to set up a separate trust just for the crypto.
Okay. Okay. Great. I think that's it for me. And thank you so much. Like I say, I hope you have a fantastic weekend. And thank you so much for enlightening me and for educating me. I was telling my daughter last night how much this class has meant to me, and being able to continue on into it, and how I feel like I was just slapped in the face with the attorney. I said, but I can't count it as a loss because I kept on searching until I found the right thing. And that's this class. So thank you again. I appreciate you.
Thank you, Miss Betty. I appreciate you so much for being here and just you took a leap of faith too, because you already went through the process and you didn't get the results that you were looking for, but you decided that you still wanted to get the training so that you can go ahead and, learn how to really operate the trust and do everything correctly. So I'm so glad that you've decided to go through the workshop, and that it has been a good resource for you. So just know that we are here to help you. So it doesn't end here, you guys. Me and the team, we're here to assist. We're here to be a resource. We're here to answer all your questions. You do have my link to my calendar, so please book a call with me. I will be able to double check your documents so that you can cross your T's and dot your I's. So go ahead and book that call with me so that I can assist you guys, and the team can also assist as well. So thank you, Miss Betty. All right. And then
You are so
Renault.
very welcome.
Thank you. Renault, do you have a question?
Yes, this is the wife.
Hi. How are you?
Very well. How are you? Thank you.
Good.
Question. We were talking about once we get everything set up, do you have a resource or a lead for tax preparation help?
Yeah, we have a CPA on our team. So I'm going to go ahead and put the information in the chat. So please go ahead and click the link so that you can book a call with our internal team of CPAs, and they will assist you with everything dealing with taxes with the trust. And they come on and do master classes. So our CPAs, you will see and hear from them. They'll answer your questions. So we don't have a masterclass scheduled as of yet, but you will get communication when we schedule the next one, okay?
Okay, thank you so much. Happy Mother's Day.
Thank you. Appreciate it. You too. Happy Mother's Day. Awesome. Maria, do you have a question? Maria, do you have a question?
Yes, I just wanted to know, have you ever gone over how to set up a land trust?
No, we only provide 3 different trusts, which is the trust that we go over in the workshop. We don't provide any other trust.
Okay, so what would a property go under?
So it depends. If it's an investment, it'll go under the business. If it's a primary residence, it'll go under the family.
Okay. Because I know I heard you spoke about how you put your first properties inside of a land trust.
So I didn't say land trust.
Oh, no? Okay. So will we do individual family trust or business trust if it's a property that we're trying to protect?
Yeah.
Okay. And the same for vehicles, right?
Yep.
Okay. That's it. Thank you.
You're welcome. All right. Thank you, guys. I am so excited that we are all done with the Wealthy Trustee workshop. So I do have homework for you guys. The first homework is for you to book the call with Gerda and her team so that you can begin the process of seeing what it looks like to implement those financial tools within your structure. The second piece of homework is for you to book a call with me once you're done setting up all 3 of your trusts so that I can double check it for you. The third piece of homework is that you are going to receive an email with a survey so that you can let us know how your experience went in the workshop. So we would love to get your feedback, and we would be so grateful. So you have already received that email. It is in your inbox. And if you could complete that survey, we would be so grateful, okay? So that is it for the workshop, you guys. Next week, we do have a Q&A session, as I mentioned, on Tuesday at 7. So you will get communication. And then we do have a master class as well. So you will look out for those notifications and communications so that you can get into the Zoom room. With that being said, you guys have a beautiful, amazing, blessed, and highly favored day and a wonderful weekend. Thank you guys for attending the workshop. Bye, everyone.
You do the same. Happy Mother's Day to you and
Happy
all the
Mother's Day.
mothers.
Thank you.
Happy
Bye-bye.
Mother's Day to you guys
Yeah,
too.
happy
Thank
Mother's Day.
you.
Yeah.
Thank you, guys.